So, hello everybody, very warm welcome to our Consumer Protection Day, organised by all three European supervisory authorities. It's great to have an audience here in person in Frankfurt, but we've also got a large number of people joining us online. We want to make the day as interactive as possible, so there are going to be lots of audience polls, lots of Q&A sessions, and to do that, we're going to be using Slido now. You can access Slido from your phone, your tablet, your computer. You need to go to slido.com, and the event hash code is CPD22, so short for Consumer Protection Day 22. If you're watching online through the IOPA website, you'll also see the link to the Slido page. And you can use Slido to ask questions if you're online, and in the room you can do the old-fashioned put your hand up and we'll come to you with a roaming mic. So, if everybody's trying out and ready with Slido now, we're going to launch our first question. It's not very difficult, I tell you. We want to know where you're joining us from today. So, if you're online, where are you watching from? And if you're in the room, where have you travelled from? So, let's see. We've got some answers coming in already. Paris, Frankfurt, but Paris is clearly winning here. Any other? Paris, Frankfurt, Brussels, London. I saw Liechtenstein up there. Let's see what else is coming up. Rome, Romania. I think it's fair to say Brussels is in the lead now, but it's fair to say we've got a good diverse audience, which is what we like. I think I've seen Hong Kong and USA, so a global audience. Before we get started, two final points. In the corner of the room here, we've got Caroline, who is visually recording the day for us. So you'll get to see some of that online, and in the room you can keep an eye out to see how that develops. And just if you're following us on social media, on Twitter, the hashtag is also CPD22, so you can see lots of comments there. But now we're ready to start. I'm very happy to welcome our chair of IOPA, Petra Hilkema, and who is also this year's chair of the Joint Committee of the European Supervisory Authorities. Petra.
Thank you, Claire. Thank you very much. And welcome, everyone. Welcome, everyone. Welcome to this joint ASAS Consumer Protection Day. It's the 9th edition, so we're almost going to an anniversary. But it's, I think, the first time since 2019 when we actually have the ability to do it in person. And you made the effort of joining us in person. So thank you very much. Welcome. And welcome also to everyone on screen, almost 800 registered. Special welcome to the person who just typed in that he's calling in or she's calling in from the North Pole. That's impressive. So I'm very happy that we're going to discuss a very important topic today. So consumer protection is a topic dear to my heart, and I think to many of us. And I think when we do our work, it is the consumer that we have in mind. But often then when we speak about buffers and capital requirements and conduct, and not really consumers, even though we have them in mind in the end. And so having a whole day where we really focus on the consumers and how we can make sure that our efforts actually benefit their protection and the value that they get from financial services and the understanding they have of whatever product they bought and how that can help them, or maybe sometimes not, and then make different choices. I think this is very important in a time that so much is changing. So I'm very excited that we have so many stakeholders interested in particularly this topic, ranging from industry to supervisors to regulators. So thanks for that. we try to make a great program for you, as we always do, and I think we managed. And we will kick off with a keynote speech of Commissioner McGuinness, the Commissioner of DJ FISMA. And I personally, but I think I can speak on behalf of all the ASAs, I really admire and appreciate how much time and effort she actually dedicates to this topic, to consumer protection and to financial literacy, and how not just willing, but really happy she was to have the keynote for this event. So I look forward to that speech, but I also thank her very much for not only today driving this topic, but really having it on her agenda in the way she does. Once we've done that, we move into our first panel. And that is about one of the new risks developing, but sustainability. And I think no one here in the room still has to debate whether or not it's a risk. I think by now we're pretty convinced that it's something we need to do with. We've seen the effects of climate change, and every year when we do a speech around this time, we can give different sad examples of impact of climate change. And it just shows that it's here, it's having an impact, it's not having a good impact, and we need to work on that. Now, that means we need to go through a transition, and in order to go through that transition, a lot of finance is needed, and we need to finance the green transition. That's what you hear. And what you see is what the Commission is doing. It's really driving several ways to ensure that capital flows are going towards a sustainable economy, to green products, to green investments. And what does that mean then for consumers? Because that's what we're going to discuss today, and that's what this panel will discuss. How do consumers know if something is really green? So how do we prevent greenwashing? How do they indicate their preferences? And do they understand when they do and what they get? I think there's many topics that are related to consumers making choices, that relate to sustainability, to their feeling of contributing to green, but also to their investments and their choices helping a green transition. And I'm very happy that Natasha Kazenav with her panel will discuss that. Now, following that, we have another keynote speaker, and that is Paul Tang. I think many of you know him. He's a very active member of European Parliament and in the Econ Committee. And I'm sure that he will provide us with some food for thought, as he always does on this topic. He's been a rapporteur both on sustainable finance disclosure regulation, as well as the EU Green Bond standards. So he knows the topic, but he's also very passionate about it, to drive it. So I look forward to what he's going to bring to this room and to the virtual room today, to keep us on the top of our toes, to make sure that we keep going also as a community of the financial sector. Now, with that, we wrap up the sustainability part and we move on to another topic, and I think this is the topic that is on all our agendas today, and it is the rise of inflation, the cost of living crisis. We see it all around. It is, I think, currently in newspapers at our tables, but it's mostly really felt by consumers, and particularly, and actually this morning again I saw it in the newspapers that I read, it is having the most impact on the most vulnerables in our society. So what does that mean when you have this kind of inflation, when you have financial products, and when you have consumers that probably now or going through winter come in a position where they have to make a choice? Do I save for later, or do I not have the ability to save for later? Do I stop certain products or not? And I think these are questions that we need to think about, and we need to, I think, also make sure that we understand what are the triggers, that we understand what are the drivers, that we see the risks, and that maybe we can also advise what could be a way forward that still ensures that even though I think this winter is not going to be very easy, but that where we can, we support consumers, and where we cannot, we at least help them make informed decisions in the short term that might impact the long term. And I think this in itself is a very important topic, and I'm very happy that Fausto Parente is going to chair that, and I look forward to the discussion, Fausto. And I think Fausto will also touch on something, but then later on we will also discuss in the third panel, is how is it with consumers and digitalization? And digitalization, of course, and we will come to that more in the third panel, is also interesting for consumers. I don't know about you, but being a working mom, just being able to via email buy the new stuff that my kid said yesterday he didn't need, and then tomorrow he discovers, Mom, my shoes don't fit in gym. And I'm just like, okay, great, I'll buy them today, and I can buy them and have them delivered to him. I think there's so many services out there now that make our life so much more easy, and it's the same in finance. For those who are digital, of course. So that's the first. How do we not miss out on having those who are less digital with us? And the number of non-digital people is huge in Europe. It has to do with having access to digital. It has to do with being able to understand and deal with digital. And maybe if you can today, but maybe at some point you cannot remember numbers that well anymore. Maybe it becomes more difficult. And finally, of course, you need to be able to read. So just being able to read is a big impediment for many in Europe still to actually deal with financial services digitally. Now, how do we deal with that? That's the first question. That is still with also Faustus' panel, how can we be inclusive in a digital age? But also what is happening then digitally? Because in the end, digital is about data. And this is where I move to the third panel. So we have so much data becoming available, and with more people doing things online, that will grow. The exponential growth of data available is there. Now the technique to analyze that data is also there. And then the need to access data is definitely there, the call for open data. But I also think that the direction is to more open data. Now, what if you have that? What does that mean? And we have some experience there because we have already open banking. We have a PSD2 that was implemented, and we can draw some lessons from that. So in the third panel, which will be led by François Michaud, it will be discussed like what lessons can we learn from the use of data, the use of this new technology, but also open data, open banking, and how would that then translate to an insurance or a securities market, and what in the end does that mean for consumers, but also for consumer protection. And with that, I would say we really touch on some of the most prominent risks we have, and we will translate that back to impact on consumers, but also what we can do going forward for those consumers, because that at least I can speak for myself, but I hope also for you, that is part of the reason that I wake up in the morning and go to work. So I cannot wrap up because the day still has to start, but Verena Ros, who's here, chairperson of ESMA, will wrap it up at the end of the day, after which we will close this conference, but we are not even close to closing. We are at the start, and I'll stop here. I'll give it back to you, Claire, and I wish you all a very, very nice day here in the room, but definitely also outside the room during the breaks with networking. Thank you.
Thank you, Petra. And with that, I think we can go straight into the welcoming remarks from Commissioner Mairead McGuinness.
Ladies and gentlemen, a very good morning. And I would like to thank Petra for the invitation to join today's event. And I want to pay tribute to Petra's work alongside Jose Manuel and Verena and all of the staff at the European Supervisory Authorities. This conference is to showcase your work to help consumers within the financial system. And this is not an easy time for consumers. Growth rates are being revised downwards, while inflation rates are higher than they've been for over 20 years. So consumers are facing higher energy bills. Their weekly food shop is more expensive. And maybe they're spending less, putting off big purchases, or indeed saving less. The effects of global instability are showing up in people's pockets. So it's more important than ever for us to work together so that consumers in this changing financial system are protected, but also empowered and confident. We can steer a new path for today and tomorrow's financial system, a path that is open to all, that is clearly signposted, and that allows the consumer themselves decide which route to take. So in that context today, I want to talk about financial inclusion, so that consumers can access the financial system, sustainable finance, so that they are informed about where their money goes, and open finance, so that consumers are in charge of how their financial data is used. So the very first thing that our path needs to do is to open access to the financial system to all consumers. If that gate is locked, then our consumer can travel no further on this new path. We need to unlock that for each and every consumer. And we have a few keys at our disposal. The first key is the Accounts Directive. This gives residents in the European Union, including people with no fixed address and asylum seekers, the right to access a basic bank account. With a basic account, you can withdraw cash, make payments, or set up a direct debit, all for a reasonable fee or even free of charge. The latest figures from the World Bank show the share of citizens in the EU with at least one bank account is quite high and has risen in recent years. But we also see that almost universal account ownership in some member states, but only around 3/4 of adults in others, meaning a quarter of the adult population in some countries cannot properly access the financial system. Now, we're currently assessing how well the Payments Account Directive has worked, and we intend to publish a report on it soon. The second key we have opened up in relation to financial inclusion is access to cash. Physical cash is often particularly important for more vulnerable groups or those without an alternative way of accessing the financial system. But the number of bank branches and ATMs has been declining, which can make it harder to access cash. So we will reflect on ways to make sure that cash remains widely available and widely accepted. The third key to open the financial system to consumers is financial literacy. It's important that consumers have the skills and the knowledge to make the most out of their money. A more informed consumer is also a more resilient consumer. I want to help consumers become more resilient by increasing the levels of financial literacy. In the Commission with the OECD, we've developed a financial competence framework for adults. That lays out the skills, knowledge and attitudes that an adult should have to be considered financially literate. We're also working on a financial competence framework for young people. That should be completed by the end of next year. And I know financial literacy is a topic that the European Supervisory Authorities have highlighted, particularly an important event earlier this year. Also coming next year is a new EU retail investment strategy, where I again want to thank the European Supervisory Authorities for all their input. This strategy will include financial literacy within the wider context of our work to help citizens participate in European capital markets in an informed and confident way. That context includes the accessibility of disclosures, also in a digital environment, the quality of advice, and the suitability of products. Now, once we've opened that gate, our consumer can now choose to take different routes along the path. So we want to make sure that they are clear, accurate and reliable signposts that indicate what lies ahead. So in other words, we want consumers to get the right information about their money and their investments. If we look at the area of sustainable finance, this is about the role of finance in the transition to climate neutrality. And there are ever more personal finance products that promise that they're delivering and contributing to sustainability. But that also brings the risk of greenwashing. Companies or financial institutions making false or exaggerated promises about the sustainability of their products. We want consumers to know about the sustainability of any investment they make and to be protected against greenwashing. This work is more important than ever as we step up our efforts to end our dependence on fossil fuels, especially from Russia. The EU taxonomy is the cornerstone of our work on sustainable finance. It provides a guide to economic activities and which ones can be considered sustainable. So it includes things like solar panels, renovating buildings for energy efficiency, insurance against climate-related risks. If you want to learn more, I encourage you to look at our Taxonomy Compass, an online guide to help navigate the taxonomy. And then there is also the Corporate Sustainability Reporting Directive, which will put sustainability reporting by companies on the same footing as their financial reporting. It's important for investors, but also for civil society and consumers, so that they can all know more about what a company is doing when it comes to sustainability. Things like a company's business strategy on sustainability, or any sustainability targets and the progress made towards them. Now that the European Parliament and the Council have reached agreement, this directive will come into force in 2024. And finally, I want to mention the Sustainable Finance Disclosure Regulation, and that's applied since March of last year. It gives consumers information about their financial products, like investment funds or pension funds, and how their money is being invested in terms of sustainability impact and risks. So this sustainable finance agenda helps consumers see what lies on the road ahead with clear signposting. Now finally, consumers should lead the way along this new path. They should keep control over their money and their data. So I want to talk about finance, which is part of the digital revolution transforming today and tomorrow's financial system. Open finance, as the name suggests, opens up access to financial data to more players in the financial system. So there is a lot more potential for innovation and personalised products and services. One example, a consumer might allow access to their credit history to a bank and get an immediate decision on a loan they're applying for. Or a fintech could develop a new platform for consumers to compare offers from insurance bases or on their claims or history of claims. But crucially, that openness about data is based on keeping the consumer in charge of their own information. Of course, that needs consumer protection safeguards to build trust, including data protection and measures against fraud and financial crime. In developing our approach to open finance, we're taking the time to listen to all sides with an inclusive bottom-up approach. We've run several consultations, and a group of experts is advising us on specific use cases that would benefit both consumers and financial institutions. And we expect the experts' report to come later this year. We will take lessons from our experience with the Payment Services Directive. I would like to thank the European Supervisory authorities for their work on open finance and its implications. Once we've taken stock of the evidence we've gathered, we'll decide on the best way forward. And so, in closing, this new world for consumers is about opening the gate for everyone, signposting the different routes ahead, and making sure that the consumer is in charge of their own decisions about where to go. We will need to work together, regulators, supervisors, the financial industry, to chart this new path and to make sure that finance truly is open and inclusive for everyone. And we should always be sure that consumers are at the heart of our work in this fast-changing financial system. Thank you, and I wish you the best for your discussions.
And so a very warm thanks from us to the Commissioner for her remarks. I'm pleased now to open panel one. Natasha and panelists, if you'd like to make your way to the stage. So our first panel today is on sustainable finance. Are EU policymakers going down the right path on the sustainable finance agenda? We'll hear the answer to that question in just a moment. Don't forget to use Slido to ask any questions, slido.com, and the code for today is CPD22, and that's also our Twitter hashtag. So, Natasha, over to you.
Thank you very much, Claire, and good morning, everyone. Really welcome again to this Joint Committee Consumer Day. It's my great pleasure to be with you and to have the honor of opening up the first panel of the day on a topic that was very well described by both Petra and the Commissioner of really the utmost importance. We are, as it was said, going through these extraordinary events that remind us day after day how important sustainability is, how important this transition to a more sustainable economy is. And we're here to discuss today what the role of the financial sector should be, could be, and what is the link with the consumers. How can we bring them along? So I think the question is quite challenging, and I'm looking to my panelists to answer it. The question we've been asked to answer today is, are EU policy makers going down the right path on the sustainable finance policy agenda? A lot has been done. We've come a long way, but there's still quite a lot to do. So the question is, are we on the right track to get there? And I think we have to try and think about whether the consumers understand, whether they are on board of what we're trying to achieve, and whether the different steps that we have taken are maybe bold enough and also taking sufficiently into account the consumer's perspective, the investor at the end of the day, that we are all trying to work for. So we'll assess whether the policymakers are on the right track. It is a new field, a lot has been done, so it's normal that to a certain extent it's not finalized. But we also have some concerns about whether the investors are actually fully understanding what we are trying to put for them. So the question we will also have to ask is, what do investors understand? How comprehensible the regulations are, the disclosures we're trying to put out to them to make sure that they actually make those informed decisions. So are we doing a good job, basically? And this is really dear to all of us. The 3 European supervisory authorities have been putting a lot of energy and effort on this particular topic, a lot of joint work to try and get it right. Everybody is fully committed, so we'll see whether that is correct. I want to highlight one element that we will come back to later on in the discussion, which is on greenwashing, where the European Commission has asked us, the 3 ESAs, to look at in particular. And we'll see what that means, what that implies. That will be a very high priority on all of our agendas at ESMA, but also at colleagues from the EBA and EIOPA. So to discuss these issues, let me introduce my panel. I think it's time. I'm very glad to welcome very talented panelists. So let me start with Montserrat Martinez Pereira, who is the Vice Chair of the Spanish Supervisory Authority, the CNMV, and who we also have the pleasure to have as Chair of ESMA's Coordination Network on Sustainability. Thank you. Welcome to you, Montse. Alexandra Machinska, who is Executive Director of Better Finance. I don't introduce Better Finance, a very important NGO in what we do, and I think we should always remember that if we want to have the consumers at the core of what we do, we need to engage regularly with Alexandra and her colleagues to make sure that we fully understand the interest of consumers. And so Better Finance has always regularly contributed to our work. Thank you for that. And Alexandra in particular is also Vice Chair of EIOPA's Occupational Pension Stakeholder Group. And I understand that she also sits on the Commission's Financial Services User Group, and you take an active role in advising policy initiatives affecting financial services users. And last but not least, Olaf Jones, who is Deputy Director General and Director of Economics and Finance at Insurance Europe, the European Insurance and Reinsurance Federation. Olaf is responsible for all the issues related to prudential regulation, financial reporting, investments and international affairs, and also a member of the IFRS Advisory Council and Vice Chair of EIOPA's Insurance and Reinsurance Stakeholder Group. So I think we have quite an interesting panel with different perspectives that I hope will bring a lively discussion on this important topic. Thank you again to the 3 of you for accepting our invitation. So we'll go through 3 topics. We'll try to walk you through first the policy-making angle. So from a policy perspective, are we taking the right steps to address the challenge that we have on sustainability, getting the right framework in place? Then looking more at the investor, what they understand, the comprehensibility, what their expectations are. And then finally trying to see what the role of the interaction between the financial services sector and the investor is. So in the advisory role, what are we expecting of advisors? But to kick off the discussion, I'm going to ask each of you one question. And I also want to remind what Claire said, that we are very keen to have an open and interactive discussion, so please feel free to throw in your questions either through Slido or in the room. So with that, Alexandra, may I turn to you first? So do you think that the current EU legislative framework on sustainable finance is fit for purpose? Are we on the right track, according to you?
Thank you. Just maybe a word of explanation what Better Finance is. I hope everybody knows, but just like one explanation, we are a federation of national member organizations, and we represent the interests of financial consumers, so, individual investors, pension savers, insurance policyholders. And one clarification, I used to be part of the FSUG, so Financial Services User Group. Right now, Better Finance is still advising the Commission, but another colleague of Better Finance. So I think question whether it's fit for purpose, and also whether from the point of individual investor the progress is speedy enough. I think this should be put in perspective, because for decades investment products and asset managers could really call ESG whatever product they wanted, and were really not accountable, and this is right now really changing fast. And we see really the regulation policymakers are really catching up with that. Whether the current framework is really fit for purpose, first of all, from individual investor point of view, a fit-for-purpose framework would be one that would really ensure reliable, comprehensible, and comparable information so that the individual investor can really be, as Commissioner said, empowered and confident and having the right information and data set. This is not the case yet. And we would think that maybe a couple of points, clarity and intelligibility. We think this is a very important rule, and actually the EU law really very rightly requires information provided to investors, to individual investors, to be clear. What clear means? Clear means that it should be presented in a way that it's first of all likely to be understood to an average member of a group to which the product is directed to, or someone who is really likely to receive it. And we think that unfortunately this clarity rule is one of the really least enforced for the time being, and we are really concerned on how it is going to be also enforced in respect to the sustainable finance products. Once we have really clear and intelligible ESG disclosures, we think that they should be really combined with other pre-contractual information, and ideally really in one information document, so that when the investor is receiving this document, they really have a holistic view of a product. Then access to data, also mentioned by Petra and by Ms. Commissioner. Access to data and the quality of data, it's definitely still not there. And as individual investors, we very much agree with Commissioner McGuinness that sustainability reporting should be really put on the same footing as the financial one. So we think that a single set of comprehensive disclosure standards that would be applicable both to financial and non-financial entities is really critical in building appropriate, relevant data set that would be useful for everybody, for all stakeholders, not just individual investors. And we think that, for example, a single management report that would really provide the information that is based on the same standards and has the same ESG standards would be really very relevant and very helpful for investors to make proper and good investment decisions. So we were very happy to see, of course, the huge consultation on sustainability reporting standards. We have responded to that. We are hoping that our comments are going to be taken into account, because we think that when they are going to be put on the same footing, it's going to really contribute to provide a comprehensive and reliable data set that is going to be useful for investors. One more thing, the most vocal and very well-held criticism of ESG, investment disclosures, is really the lack of accountability and the lack of measurability. So we think that one of the solutions to that could be impact investing and have impact investing standards really applicable and becoming really the norm. And by impact investment, from the individual investor point of view, we understand it as an investment that is really made to make a positive, measurable social or environmental impact. And I cannot underline this enough, alongside the financial return. And we really think that positive, real, long-term financial returns are really part of sustainable finance product and investment discussion. And especially when we think and we discuss the current macroeconomic situation, we heard already the speakers before talking about inflation. So we think that this discussion about providing really the value for money is just as relevant for sustainable finance and investment products as for any other financial products. So maybe as the kickoff comment, this would be.
Thank you very much, Alexandra. That was very, very interesting. So first, some positive change, if I summarize well, that the ESG disclosure now, you can see a real difference in terms of the expectations and some guidance there, but also quite a lot of areas where we can improve, making the clarity clear, not to make a bad word, make sure that it's enforced, making sure that the data is there, that we can actually measure, and a very concrete proposal also. And we'll come back maybe to that on what the investor expectation is in this area with the proposal on impact investing, what that would mean concretely and how that works with financial returns. So thank you very much for those introductory remarks. Monse, what is your take on whether we are on the right track? A lot of work is being done. Are we doing the right thing here, or are we sidetracked?
And thanks for having me. I'm delighted to be here. I think I'm going to echo many of the things that already has been said, also by the chair of IOPA, by yourself, and also by Alexandra. I'm just going to say 3 areas from a supervisory point of view that I think that we really need to focus on, the places where we really need to focus on. But first, let me highlight, and again, as I think Alessandra also mentioned, that to put things into perspective, because we have to acknowledge the massive progress made so far from for European authorities, from all the regulators in developing a sustainable finance legislative framework that is allowing the finance precisely to play its role in helping the transition and also in helping in tackling the climate change risk. So I think that we really need to keep this in mind, because a lot has been made in a very short period of time, and it's normal that under such circumstances some problems, let's say it this way, may appear. But I have, the other day they were telling me even the number of pages that we have in terms of the legislative framework, and I know that we cannot measure the relevance of a legislative framework in terms of number of pages, but if you look at that, just the delegated regulation of the taxonomy has more than 350 pages. So, and overall we're talking more than 2,000 pages of a legislative framework. So we have to want to emphasize this, because I think it's important to remember. And we know that much more is in the making. Having said that, are there pieces missing? Many. Are there things, problems that need to be addressed? Several. And I think that we will agree that there are some inconsistencies among the different pieces of the regulatory framework. Definitions may lead to confusion in terms of the taxonomy when you compare to the disclosure regulation. There's also, let's say, the complexity. Alexandra mentioned that, and it's true. The framework is quite complex, and we need to do everything that we can. It's in our hands to simplify it. And one may argue as well that we had put the cart before the horse. I mean, that we are asking for disclosures when the data and the framework that regulates the quality of the data is still not there. And yeah, to some extent that's true. But I think, again, that we need to put things into perspective. But going back to your question, what are the 3 main messages from a supervisory point of view that I think that I would like to emphasize here? First, for me, one of the most important thing is that we need to finalize the legislative framework. Sometimes I hear some voices asking to postpone the sustainability reporting disclosures or delay it a little bit to give more time to market participants to have the way to deal with the new requirements. I think that we cannot afford that. There are many other tools that we can use, as proportionality or other ways to facilitate this. But we need that. We need to have the legislative framework to be completed. So I would encourage to finalize it as soon as possible. Second, the need to improve the framework in terms of the consumers and investors, to be able for them to understand what we are doing there. The framework is quite complex. The legislative framework is quite complex. So we need to simplify. We need to help consumers and investors to navigate in this new world. And my third point would be the need as well to focus on supervisory convergence and supervisory enforcement. This is now we have I think you mentioned, Natasha, it's been a year and a half or 18 months since the disclosure regulation has become applicable. So now we, as supervisors, we have to check and review how this new regulation is being implemented by market participants. The thing is that it's not an easy task, and there's always the risk of greenwashing that we will have time to discuss about that, but definitely is what we have now on the table. So just highlighting the progress that it has been made, a lot of work has been done. Let's just keep going and finalize it as soon as possible.
Thank you, Montse. Also, a lot of interesting, I'm not sure if everybody would agree that 2,000 pages is a good thing. Maybe, maybe not, I don't know. But certainly a lot of work has been done, and so a need, given that the sustainability is there, it's there to stay. Petra reminded us of that we can't really afford to wait, but areas that we need to improve, the complexity, guide everyone, help the investors and the industry navigate, and potentially start working already now on convergence and enforcement also, to Alexandra's point. So Olaf, what does the industry think here? Does it help? Does it respond to their concerns? Does it provide helpful guidance, or is it preventing the industry from developing products?
Well, thank you very much for the opportunity to join this panel, and just also a small correction.
Oh.
I was vice chair of the IRSG, but now I'm on the OPSG.
Okay.
In the past. But
go back to my notes next time.
no, I think that there's sort of a short answer and long answer, and I think the short answer is, first of all, we can't yet judge whether it's fit for purpose. It's not finished, and there's still work to be done, and elements that have been finished are not yet implemented. And I think the second high-level comment I would say is that I definitely think we're heading in the right direction. Whether that we're on the right path, the right track, that's a slightly more complicated answer, and I'll spend a bit more time on that. So I think the insurance industry, as I hope is well known, that has been considering sustainability for many years. It's core to many of our products and what we offer and what we do. And we've been at the forefront of sustainability-related disclosures and actions, and we'll come, I think, back to that a bit more later. So we remain very committed to supporting the transition to sustainable economy, particularly to tackling climate change, and we support the ambitious objectives of of Europe and particularly the European Green Deal. We know we can play a really big role on providing protection, on providing investment, but also providing support for prevention and mitigation. However, I think this is part of a really much bigger transition. So the role we can play in the insurance industry and the financial industry more generally is so closely linked to what's happening in society. So what we can do is linked to that. And so we are very supportive of the fact that the EC have moved, the Commission and Europe has moved from a focus on sustainable finance to the whole of society. In that sense, we're very supportive of the total policy agenda, and I think it goes beyond the specific elements such as SFDR and what's being done to give consumers information. So I think it's worth sort of touching on the whole framework, because without the whole framework, we will not be able to offer products, we will not have the data to give to consumers. And so if we step back a bit, if we look at the total legislative framework, first of all, we have the Green Deal, which covers pretty much everything. And within that, we have things like the Fit for 55. And elements of that are key because we need, in order to offer sustainable products, we need sustainable investments in order to be able to say to offer customers investment products which have X amount of sustainable elements or climate-related elements. For that, we need companies to change, to initiate sustainable projects that we can then invest in. We need society to do more on prevention and adaptation in order to make sure the products we can offer remain affordable and, in some cases, even insurable. So the larger scale efforts of the Commission are really important. One of the other elements is green bonds. This will allow us, we hope, once it's finalised, to direct significant investment into green bonds, which will provide transparent and consistent information and reliable. We need to define what is sustainable, and that's, of course, the taxonomy. But within the taxonomy, we need to get the details right. We need to get the level 2, and we need to make sure it's working. We obviously need to provide information to customers through the SFDR. But again, we need to get the second level details right, and we'll talk a bit about that, I think, later. And of course, we have the problem of where do we get the data from in order for us to report, as has been mentioned. Now, that's coming from the CSRD and the European Sustainable Reporting Standards. The problem for us, of course, is those are going to come later. And that creates a sequencing problem. And now we're going to have to manage around that because we have to report from next year. We're already reporting certain aspects of that. We're going to have to report more, but that creates a challenge. So we're not saying the framework is wrong, but there are challenges and we need to get the details right. It's worth noting that within this CSRD, the ESAP is really fundamental, the electronic single access point, because without that, there will be a huge amount of data, but accessing it will be very expensive and complicated. The ESAP, if it delivers on its promises, which we really hope it will, and we're very supportive, will give us very efficient access, but also consumer organizations, academics, everyone. And this could really be a game changer. We need transition plans. Now, the insurance industry many insurance companies are already looking at transition plans, developing transition plans, but again, we need them from the wider society. So in the Corporate Sustainability Due Diligence Directive, we're very supportive of the element requiring transition plans for, I think it would cover an expected 11,000 companies. And that, as I said, will trigger investments that we can change. But there are other aspects of the Corporate Sustainability Due Diligence Directive which are very problematic, and issues around the value chain definition for insurers and a range of other things which really need to be looked at and improved. And finally, of course, I have to mention the Solvency II Directive and the review there. We are very happy that's been included in the whole set of initiatives that are needed, and we need that to address the excess volatility and capital requirements for long-term business and to make sure we can play our full role in investment. So I think we understand the urgency, but we have to find a way within that urgency to get the details right, to get the sequencing right, and make the whole system work.
Thank you very much. That was very helpful because I think it's important to remind ourselves of that broader picture, and that actually the financial sector is just one piece of this ambition. And even if you look at the consumer perspective, we're also being asked as individual consumers to change our practices in a number of areas to be able to be more fit for the sustainability transition and what that means also as a society. So I think it's important that you bring that to the table as well. If we look then at the financial sector, I wanted to touch upon a few points you mentioned. I think all three of you seem to agree on the degree of urgency, on the fact that it's work in progress, so not fully there, and with different emphasis on what should be the area of focus and what we should be looking at. Interesting to see that bigger picture also and the broader. But I did want to come back to the disclosure angle, because that's, from a financial services industry perspective, that's what the investor sees first. And also because the European regulation has started with that. Right or not, that's the way it was started. So the investor sees products, gets some information that is regulated, and then makes an informed or not decision. So I wanted to now move on to what has been mentioned in the introductory remarks, both by Petra and the Commissioner McGuinness, on greenwashing. But first with a question to the audience, so please go to your apps, I suppose, to be able to answer the question. This is the first question. And to take a closer look at the greenwashing risk, the first question is very simple, but it's to say, do you have a clear idea of what greenwashing means in practice? Because we do mention it a lot, but it's interesting to see whether you have a clear view. So the answer number one, can we pull it up? I'm just checking. I don't know if you see it on the screen or... Okay, you do, because I don't. All right. Answer yes, I have a clear understanding of what greenwashing means. Answer number two, no, I'm not really sure what that means. And answer number three, yes, but I would really benefit from some guidance on how to really identify it. Yes. And now it's come up. And so we have a majority who thinks you think you know, but you would appreciate some further guidance. And a solid third who could help us give a good definition. That's good. We're going to ask you to contribute to our work. Excellent. So I think I'm checking if we have a bit more time or if I think it's final now. All right. So thank you for contributing. I think it's important because very often in these discussions we talk about greenwashing as if it was obvious. But if we listen also to Alexandra, for example's proposal on impact investing and making sure an investor who would really want to make sure his money actually has a measurable impact from an environmental or social perspective and at the same time get some financial return out of that investment, I'm not sure all the products labeled ESG could actually meet that expectation. So it's very important that we can make sure that when the investor comes to make an investment, he or she has a clear understanding of what actually the product can deliver, what is the promise, and have an alignment there. So that's also one of the key areas we're going to be looking at and what the Commission has asked the 3 European supervisory authorities to look at. So let me to go a little bit further on this issue, Alexandra, I'm going to turn back to you to ask you, what do you think investors correctly understand? Do you have surveys or data that you could share with us on what, from your perspective, do investors fully expect in this space, and what is their understanding? Are you really concerned with greenwashing risks?
Yes, well, yes, we are very concerned. We are also concerned about like proliferation of different standards, rating and labels, because we think that if they are not really, if there is too much of labeling and different standards, it also does not contribute to a better understanding of the product and of what really green means. On top, when you look, for example, at different, if I may start with also ESG ratings, because Better Finance has also done research into this area, and we really found what also other organizations that have been looking at ESG ratings found, there is really very little correlation between them. So if an individual investor would like to get a bit more information about what is the rating either at the company level or at the fund level, and would try to compare, he would be very confused, or she, because they would find that the same company or fund could be rated very differently by different ratings providers, that methodologies are not clear. Sometimes also there is this peer group ratings done, but it's not very clearly disclosed. And it can be quite confusing for sustainable-oriented investor to find out that, for example, tobacco company is rated pretty high on the scale. And yes, there are many surveys and studies done already, for example, by supervisors. In France, the AMF has been supervising consumer and investors, and it was pretty clear that the majority is really interested in sustainable finance and investing with making exactly this, a good, positive impact, either social or environmental, and investors really expect impact. So they can be then pretty badly disappointed to see that what they understand as measurable impact is not really what is going to be provided at the very end of the investment process. And for example, for 76, so this is from the AMF study, just let me check, 76% of French people say that environmental impact is a very important issue from them, but they also claim and confirm that they stay away from sustainable or responsible investments due to lack of clarity and exactly fears of greenwashing. Many of our member organizations of Better Finance are also very interested in the topic of sustainable finance, also because their individual members would like to invest sustainably, but again, don't feel confident enough really to make this investment decision. So the very recent survey that has been done by our German national organization, DSW, done just 1 month ago, found out that, so the survey has been done among 150 individual investors that went to seek investment advice on sustainable finance products. Most of them claimed that they, after the investment advice process, they still remained quite reluctant to invest sustainably. Around 64% did not follow the advice that was given to them during the advisory process. And they were not really sure whether really what was advised to them really exactly matched their expectations that were communicating to the advisors. They also confirmed that the main source of information for them, were looking and informing themselves about sustainable finance products, was either the internet or the information document. When they were then asked like what kind of information was also provided on the sustainable finance product that they were looking for, around 60 were informed about the return and about 50 about the cost. And many said that they were actually missing this information, that it was not given to them. And really many said that because of the recent media information about the down rates in the German market done by the supervisor and some additional actions that were taken by supervisors in other countries, they are really aware about the greenwashing. They don't necessarily understand what it really means, but they prefer for the time being to really stay away. And for all those who are really interested in more detailed findings of this survey, it's going to be aired on the ZDF, if I pronounce correctly, on 28th September, if you would like. So for all German speakers, I highly recommend to watch the documentary.
Thank you, Alexandra. So quite concerning outcomes, I have to say, from what you're describing in terms of the mismatch between what the investors are trying to seek and what they're getting, and the fact that there are some strong concerns. So clearly the challenge is high. Montse, from a supervisory perspective, how are you looking at this? How are you as a supervisor trying to go about ensuring proper information to investors? And maybe you can also touch upon what's being done at the EU level?
Yeah, sure. Just saying that I was surprised that there are almost 40% of the people at the polls said that they understand the concept of greenwashing, because we're still working on it as supervisors. I think it's definitely one of our priorities. Of course, it's on top of our tables. It's one of the priorities for ESMA. In fact, it's the first one in the roadmap of sustainable finance of ESMA, tackling greenwashing and increasing transparency. But it's not an easy task, because greenwashing is a quite wide, quite broad concept. And usually when you think about greenwashing, the first thing that comes into your mind is, okay, it's a problem of mis-selling. And that's true, it's mis-selling, but it's not just that. Mis-selling would be just the tip of the iceberg. There are many other areas of the investment value chain where greenwashing could appear. And we need to really have this deep understanding of the phenomenon, because it would be the only way for us to understand the triggers or the drivers of the greenwashing risk, and then be able to select or to choose the appropriate response from a supervisory point of view. And this is why the work of the ESMA, together with the two ISAs are doing, is so important. So as I said, greenwashing could come from the beginning, from just the source of the data that the companies undertake are publishing. And this is where the regulatory framework needs still to be completed. We have the need to finalize the corporate sustainability reporting standards, also the ESG ratings framework, because it's just the data that is published by companies, how the data then is processed by ESG ratings agencies, ESG dating providers, then how companies use this data to package in a product that then is sold to final investors. So it's the whole process. So first, it's not easy, because you can have greenwashing in a very different phases, and we need to really understand that. Second, also greenwashing could come as a result of the lack of clarity of the regulatory framework. I mean, we can have, let's say, kind of unintended greenwashing, because maybe some of the regulatory framework is being interpreted in a different way in different jurisdictions. So this could also lead to confusion. And we need to understand that, because the response from a supervisory point of view will be different in this situation than from the first one. So this is why I think it's not an easy task, and we really need all the contributions to really have a good understanding of that. And how are we approaching this from a national supervisor, and then also from together with ESMA? From a national supervision point of view, what we're doing is following a double approach. First, what we can call an ex ante or a prevention mode, like, okay, let's keep this interaction with market participants, like let's publish guidelines, let's help the market to implement the new regulations. Let's hear what consumers and investors have to say, where are the problems. So that's very important, and this is what the result of all the Q&As, public statements, and all the interaction that we are having with the market, and to precisely prevent greenwashing from happening. But then, of course, there is the ex post actions. This is when we as supervisors, we need to step in and use our supervisory enforcement. As I was said before, this is becoming more important right now. It seems some of the regulatory framework has been there for a year and a half. So let's now review how this new regulatory framework is being implemented. But as I was saying, I very much welcome the work that ESMA, together with the other two European authorities, are doing at this front, because we need to have a better understanding of the greenwashing phenomenon. And I think that the approach that ESMA, in particular, that is the one that I know, is taking is very good, because what they are doing is also identifying particular cases of greenwashing and having a discussion with other NCAs. So we're gathering input from different sources, and this will allow the ESMA to report and have an answer to the European Commission on this call for advice or to understand the greenwashing phenomenon. I think that the idea is to have a first report by May next year, 2023, and a final report by May 2024. And probably ESMA will launch some call for advice or some public consultation as a way to continue with the effort that ESMA is doing in gathering as much as information as possible and having this interaction. I also want to mention as an example as well the new consultative working group that ESMA has established in the sustainable finance arena precisely to gather this input from the different stakeholders. I think that's very important. So I think that there's only one more point that I would like to mention here and emphasize as well, that this work, we cannot do it alone. I just mentioned the interaction with the market, mentioned the interaction with the other national competent authorities, and precisely the interaction with the 3 European authorities, because it could happen, as I said, at all the investment value chain, but it's also quite cross-sectoral. And nowadays, we cannot really differentiate between sectors. We need to have this whole approach and work together to precisely identify the correct tools.
Thank you very much. So we can see the expectation is very high. There might be a real disconnect between the actual expectation of investors and what they're being offered. Strong efforts done by the regulatory community to try and get together and be on the ground to make progress. Can you reassure us, Ola, from the industry side, what preventive measures are you taking? Do you have concrete examples to reassure us that we're not completely in a situation that is lots of control? What is the industry doing to try and address this concern and be clear in the products that are being offered to investors?
Well, I think here we end up with, again, some of the sequencing issues. You know, we have, up to now, insurers have been looking at developing sustainable plans in terms of investments and certainly to a certain extent also products. And as I said, they're limited how much they can do because of how much of the investable sort of landscape is sustainable and green. And now we have some specific requirements coming in, and in order to make sure you're complying to those requirements, you need data and information. So the message we're getting from the supervisory community is, in this particular case, a best efforts approach is not really acceptable, and you have to sort of make sure you have the data, and you have to be sure it's green. You can't be doing your best to make sure it's green, and that creates real problems in terms of offering products. So there may have been products on the markets which were greener than anything before, and maybe quite very green, but maybe not green enough to satisfy the new requirements. And those products, then there's a question, there's a big uncertainty and nervousness about offering those. Do they need to be taken away, etc.? So I think we're at a point where, in a way, we fully support the need for all of this. In fact, we want a framework whereby we can have confidence in the investments, and that we're not being greenwashed with the companies we're investing in, and the things we're doing in terms of, and seeing in terms of prevention and mitigation. We also want our customers to be confident that if they buy a sustainable product from us, that they're getting what they expect and what they need. So we need that framework, but there is that, again, sequencing problem of in between going from sort of good intentions to regulatory compliance. And I think that is something that's still being navigated, because we're still in the process of implementation. To what extent is data available? It's not available yet from where we want it, from the CSRD and ESAP. To some extent, it can be available from other sources, but sometimes that's expensive to get and not always consistent. And you can get, the problem was mentioned about the same investment being deemed maybe sustainable and not sustainable by different rating providers, etc. So there's a lot of challenges right now, I have to say. So I don't think I can give you that easy reassurance. What I can say is that the industry is really doing its best, and trying hard, and obviously interacting with all the processes to make sure that we get to a point where this is workable. But I think it was mentioned about the information. I think consumers, and we've had this in other aspects, and it's the same for sustainability. Giving them too much information just doesn't help, and we need to find a way of boiling it down. And things like, obviously, the EU Green Bond is a very simple sort of idea. You either you satisfy the requirements, and then you're green. Obviously, we have to follow up and make sure that that's all working in practice. But the conceptually, you can see how that works. The labeling will come, I think, to that a bit later. That is a potential way of giving simple information and combining a lot of detail into a simple message to consumers. So we need to find ways of doing that. But there are some concerns. I mean, if we look at the SFDR at the moment, the detail level, the templates, I think we see something like 5 pages of pre-sales information for the consumer, and we're not sure that's going to work. So again, we really need to think about what works for the consumer. And then I think the final point I make, I think the request from the Commission for the ESAs to look at greenwashing as a general topic, including defining what it is. It may or may not be clear. I think there's a lot of scope for improving the clarity on that. I think is really important. It will be a very challenging project, because even though you have quite a good time to do it, and I think it's very good to have an intermediate report and then a final report, the framework still will not be fully in place, or will only just be in place. So judging whether it's suitable and working will still be difficult, but I think an early assessment makes sense, and then we can look at some of these issues to see whether there's some urgent need for addressing gaps, or indeed things which are not working with the consumer, or are not working from a practical point of view for providers such as insurers.
Thank you, Olaf. So you've explained quite well. I find the fact that, since we are on that journey, that some elements of the regulatory framework are in place, but not all of them, that we need to make sure how we navigate in that particular time. So from supervisory perspective, already some elements can be enforced to try and stabilize some concepts and clarify also what really is not acceptable, but we need to accept that there's some degree of uncertainty. So back to you, Alexandra. In this context, quite challenging, do you think that the efforts that have been done in terms of the disclosures and the type of information that is being suggested to be shared with investors, is Olaf right to be concerned that the 5 pages are too much, or have the efforts of trying to make those comprehensible the right ones? What's your take on those efforts to try and make the information actually understandable?
So yes, well, from the surveys and talking to individual investors, so individual members or our member organizations, it is pretty clear that they do feel overwhelmed with the amount of information they receive, and additional disclosures on sustainable investments are heavy on them. There was also done a consumer testing for the ESAs by the Warsaw School of Economics, or in the group that was asked different questions during the testing. It was focused really on young people, also from the economic faculties. So with this, you could say, elevated understanding of many different concepts connected to financial products. And the outcome of this testing was rather disappointing, in a sense that the group was really overwhelmed with how much information was provided to them. They really insisted that investors should be provided with really well-tailored information. So really not more information, but better quality information, better tailored information to their understanding needs. What was quite concerning was that almost half of the participants of this testing really had difficulties to understand even the connotations of certain icons that were used to simplify the templates, and they had problems really to understand the reference to sustainability. 50% really perceived that the pro-contractual documents were much too long and complex. And also when they were then tested on their specific knowledge of sustainability concepts and different questions related to sustainability, again, only half of them were able to answer the questions correctly. So also this basic knowledge on sustainability was quite scarce. So in our opinion, of course, disclosure documents have really potential to boost the understanding of individual investors and consumers in terms of what sustainable finance product is offering and what it really is. But it has to be more streamlined. And as I said at the very beginning, you would really have a plea for giving the opportunity to investors to have this really holistic view of investment product and financial product. So like really ideally it would be 2 pages. I know it's a challenge. I mean, except of course for more structures and complex products. And this additional non-financial disclosures should be, of course, provided in intelligible, comprehensible language, plain language for investors, and not really take probably more than 1 page if we really want people to read it and be able to understand it. I would also really invite everybody who is in this room and is also very much interested in like more views from individual investors on sustainable finance, sustainable investment, to come to Frankfurt just before the Sustainable Finance Conference of EIOPA on the 7th. So on the 5th and 6th, we are going to be here with lots of individual investors discussing sustainable finance and sustainable investments. And also, Better Finance is quite involved in quite important project, especially right now in the current geopolitical situation, on energy efficiency investment and sustainable energy investments. And it was already planned really to have a working group quite broad. So we are really inviting all stakeholders to join us, really to discuss greenwashing, so quite timely in the context of the work that the ESAs are doing, and also the green marketing claims. So we are going to be reaching out to you to involve you in this, and we are going to, we are hoping on a positive answer from you. We would really like to discuss it and to really provide a very well-informed input also to work of the ESAs and the Commission to really have a well-defined greenwashing definition. But we would also like really to finally define mis-selling, because we have been really discussing this already for a couple of years. We had a good reports also from the European Parliament and the Econ Committee, but we really still lack a mis-selling definition. And in the context of greenwashing, I really find it quite important.
Thank you, Alexandra. So looking forward to the constructive input that you can bring. I think all the positive energy will be more than welcome in this debate that is very challenging and where we really want to make sure we bring along all the perspectives and get it right for the investors at the end of the day. I'd like, before I move on to Monte, to pull up the second question to the audience, to ask you whether, because we're going to try and discuss the question of whether labels could help us here. So we've seen that the information is overwhelming. So maybe if we go for labels, would that be a solution? So the first question to the audience here would be, do you see a need for European label for sustainable finance products? So trying to get a sense. Yes, labels will help guiding investors in their investment choices. No, there are already too many labels out there. Or no, investors are going to get even more confused. So very much looking forward to feedback on what the views in the room are on this one before I turn to our panelists again. Interesting. So this is a very strong push. I don't know if the Commission is connected, but we have a very strong, clear view from the room and people connected in favor of labels to help guide investors. I think that's very interesting. Okay. Then I was going to turn to you, Monte, to give us your views on that. So do you think that it could help improve, and if so, how? So you know where the audience stands, but you can definitely say that you don't think it's a good idea. Please, the floor is yours.
I think it's not an easy question, but I'm surprised the 80%, almost 80% of the answers going definitely very clear for label. Of course, labels are useful. We have labels in other parts of the economy, and yes, what we are aiming for here is to clarify the message to investors and also to avoid or misleading. Yes, label seems quite an easy way to do it. It's a way to simplify the information. It's a way to clear the message, and it might help definitely. But just to introduce some debate on this result of the poll, I think also that when having this debate, or while having this debate, we need also to keep a few things in mind. First, we know that there are already in the market few labels in many countries. We have France, we have Belgium, I think, and Luxembourg, and all of them have are following different approaches with different characteristics, different level of criteria. So we need to be careful, because proliferation of labels could also lead to confusion in the market and increase the noise to investors. So we might end up losing precisely the informative power of a label. Also, not to mention that it will imply a fragmentation of the market, and we are not looking for that. On the other hand, if we go to a very simple label, we are also losing information that could be valuable for investors. So we need to strike a right balance there. So labels are important, yes, and I think could be a very good solution for investors and helping them to navigate in this new world, as Alexandra also mentioned. We need to bridge the information asymmetry between asset managers and investors. We need to reduce this gap, and labels could play a role. But just keep also that a few considerations in mind, because I think the debate is not as easy as it may seem. But as a supervisory point of view, right now, what for me is more urgent is also to clarify the use of ESG terms when naming funds. We know that the disclosure regulation is precisely a disclosure regulation. The SFDR is not meant to be a label regulation, but sometimes it's been used as such. And there's still some clarity that is still needed in understanding what an Article 8 fund is, etc. So apart from that, sometimes the terms of sustainable, impact, ethical, social could be used in the marketing material or when promoting or selling investment funds, or could be used in naming the funds in a way that could be misleading or not properly aligned with the underlying characteristics of the product. And this is where supervisors will need to be very careful of that. And I very much welcome the supervisory briefing that ESMA published last May, precisely offering some guidance to us in how to use, how the asset managers could properly use ESG terms when naming funds. And I think that's very important because we need this common approach precisely to avoid the fragmentation, but also to avoid introducing more confusion in a market that per se is already very difficult, very complex. And it's clear from the poll, and it's clear from what is being said already here in this panel, that there's this need for clarification, for simplification of the framework. So also, it's very important that we don't introduce more confusion, and the use of terms such as ESG terms, such as sustainable impact, or etc., need to be properly aligned with underlying characteristics. So, in favor of labels, I think that we need to work on that, and also have a common understanding. I think it's very important as well, this common understanding from a European perspective.
Thank you, Monse. I'm going to turn to Olaf in a second, but just to indicate, I don't see at all the questions on the screens. If somebody could pull them up so we can try and see and pull some from the audience, it would be nice that we can try to bring them in. Thank you for that. Olaf, so what's your take on labels? I think it's interesting. I'm expecting questions also, given that Monse was much more balanced in her comments. So what is your view? Could that help?
No, I think it's clear they could help. I think the challenge is designing them so they work in practice, like many of the aspects of sustainability. But I think that it's definitely worth trying to do that. I think, as was mentioned, there are some national labels, and some of those do seem to be working. I think the challenge comes when you try to develop labels at a European level, because of the difference, especially in insurance products at least, across different markets. It also is a challenge if you try to create labels that work across multi-sectors of the financial world, because again, does it really capture the specificities of different products? But I think we've seen some success on a national level, and I think that shows it can work, I think. Then there's a question of, is it more useful to try to get some consistency in how labels work across Europe, rather than maybe trying to always for a European label. So I think there are some questions of how we can make labels work. If we look at the eco-label for retail investment products, I think that does have some potential. I think it's focused on insurance-based investment products, IBIPs, that are in scope. And I think if we get the details right, that could be there could be some it could work. But again, the details need to be right, and I think that's the challenge. But certainly, I think work on labels is certainly justified, because it gives that simple signalling to the consumer that they're looking for. Sometimes it's not so easy to make things so easy, though.
We're going to take some of the questions, if that's okay. So I think we can take two for you, Alexandra, if you're okay. The first and the last are similar in terms of saying, okay, you're talking about disclosure documents, so how do you find that balance between the disclosure overload and making sure at the same time that you get comparability, and it's not all done at the cost of clarity. If you just simplify so much that then you don't understand what you're doing anymore, and combine that maybe with the question from someone in the audience who's saying, would it be an idea to follow the advice from the economists? Sorry, I hadn't read that proposal, to limit the reporting to emissions only. So would that be sufficient given what the investors' expectations are? Maybe in 1 minute. So what's your take on that?
Yeah, well, of course, this is a challenge to have a really well-designed information document that discloses the information that is relevant for consumers, really helping them make informed decision and drives comparability. But I think also very helpful in that is using this method of consumer testing. So really have the documents tested with consumers, and really seeing what kind of information is for them understandable, where more plain language is needed, and also what kind of information they don't understand and they don't think they really need. So I think this would be already quite helpful, and also insights from behavioral science. I think it's being taken by the national supervisors and regulators more and more into account, but I think this could be followed up even more. Yes, I saw the advice from the economists to limit the reporting to emissions only, but I would not really agree with that. I think that also because of what is the demand for information from individual investors, it is not limited only to emissions only. Investors also want to know and have the information on the governance side of the reporting, and also more and more important for them are also social issues. I know we don't have the social taxonomy yet, But I think in the current situation, limit ourselves just to reporting on emissions is not the right way to go.
Okay, thanks for being concise and addressing clearly the questions. Monse, I'll give you the second and third question, if that's okay. The questions are, Monse mentioned the need for supervisory convergence and enforcement, and what's her view, what are the key impediments to make sure that those efforts are actually effective? And the other question was, how can we use lessons learned from more traditional misconduct and mis-selling activities, and so in the traditional financial space, and how can we apply that to sustainability activities? So really a question to the supervisor there on how can you be effective in this space?
Yes, thank you. No, regarding the first one, the need for supervisory conversion and enforcement and the key impediments, I have emphasized this during my intervention because when thinking about the market investment, the investment product market, in Spain, for instance, just to give you a data, more than 40% of investment funds that are sold or promoted in Spain come from other jurisdictions. So we cannot approach this from a national supervisory point of view. We cannot have one label in one country and another label in another country because first it goes against the capital market union, the capital markets union, but also it's not the reality that we have right now, and we cannot offer this, in theory, same products to consumers with different names or different labels or different characteristics. This is why we need this supervisory convergence. I'm not saying that we are not doing it. I think that the work that ESMA, and I'm sure that the other European authorities as well, but the work that they are doing in enhancing supervisory conversions is of utmost importance. It's very, very important. And what we have to do is precisely just to be sure that ESMA has the appropriate tools and the appropriate way to do it, and also that all NCAs are aligned in that sense, and we follow the same approach. We were talking before, I was mentioning greenwashing. Sometimes, as I said, greenwashing could come because we're just following the rules or interpreting the rules in a different way in different jurisdictions. So we need to be able to identify those cases because the solution or the response to this situation is different. The response is precisely more supervisory conversions. I think we are aligned on that. I think we are all going into the same direction. It's just that we need to really go a little bit more and be convinced that European authorities have definitely a massive role to play in this area, precisely when it's completely new arena, new front, where we need more clarity, where we need more guidance, where we need more interpretation, because it's a process that we're learning by doing. The second question, it has changed.
Yeah,
okay.
the question was how do you use experience from traditional activities of mis-selling, misconduct,
yes.
and how you apply that to sustainability.
Yes. No, it's a very good question. It's a very good question because definitely it's quite similar in the end. We are talking about mis-selling. We are talking about publishing information from companies that is not adequate, it's not properly assessed, maybe, or that is not fair, that is not precisely accurate. So it's exactly the same. What we are doing precisely as a national supervisor is that each area that is in charge of the enforcement in the disclosure department, in the investment fund, in the supervisor, in the conduct, precisely what they are doing is just introducing in their day-to-day work the sustainability concept. So there's a lot of the process that we already have in place at national perspective from a supervisor. What we're doing right now is just adding the sustainable finance perspective. But of course, we have the procedures, and we're using the same procedures that we already have in place.
Thanks. I'll keep the questions for Olaf on you have questions for you on the label, but just so that we can move on a little bit on the third aspect that I want to make sure we cover, which is the idea of how do we ensure the connection at the point of sale level. So when you have the advisor speaking to the investor, making sure they speak the same language. So is that actually working? In your the results from your survey that you mentioned, Alexandra, that didn't seem to be the case really. But let's go a little bit into that. And for that, we also have a question to the audience. That is to ask, well, this I would expect, I hope you have a clear answer. How important is sustainability to retail investors? So 3 possible answers. It's very important. It can both mitigate investment risk and address key issues such as climate change and social justice. It's important, but good financial returns are also important for investors. Or it's not important at all. Sustainability is just a marketing tool that people are using now to sell their products. So important to hear from this audience what your take is, and I think some of you are in different positions, so interesting to see if you position yourself as the investor, as the financial advisor, or from the ecosystem, the stakeholders. Here we have a very clear-cut outcome. So most of you believe that sustainability is an important expectation of retail investors, but a little bit what you were saying actually, Alexandra, or maybe you have convinced the audience that it has to go side by side with good financial returns also. So that's the expectation going into the room with the advisors. So let's talk a little bit about that and the sort of distribution aspect to all this. So this will be a question for you, Ola, first, perhaps to say, can you share a little bit what you see in terms of the insights or challenges that the industry is facing in this consideration? As you mentioned, we are in this in-between period where it's not perfect, but you still need to respond to the demands from investors coming to you. So how do you deal with that?
Well, I think there are sort of multiple challenges, and I think the one we've already discussed is the timeline and the challenge that creates to have the products and the data in line. I think that means that right now we're asking sustainability preferences without necessarily being able to offer in a fully compliant way the actual products. Even if there are products there, they no longer may fully comply, or we can't be sure. Guarantee they comply, and therefore, as I mentioned, that the fact that best efforts is not good enough does create a problem. So that I think is definitely a key challenge. I think the other challenge is the fact that there are multiple requirements in terms of the sale process, and it comes back to, in a way, the return versus sustainability. Now, just because something's sustainable doesn't mean it's not going to give a good return, but it also doesn't mean it will give a good return. And in some cases, there may be some differences. And I think making sure that the options are presented in the right way is key. And that comes also to the amount of sort of the burdensome nature of the sales process. And I think obviously there's a lot of information that needs to be provided already. I think something like 160 pieces of information need to be provided pre-sales, and I think that's going to go up to something like 190 with the ESG. Now that is at the moment can be overwhelming for the customer, and also makes the sales process difficult. Customers can get very frustrated. Why can't this be faster? I know if any of you have been through the process, sometimes you think, well, we have to sit down and take an hour to do something, which there feels like there could be a way to do it more efficiently. But of course, these are also important issues, especially with things like long-term saving products. It's crucial the customer really understands what's on the table and the things they have to consider. So we're getting that to work across all the different requirements is difficult. And we know that after the retail investment strategy, there may be more. I think there's looking at value for money, looking at suitability. So again, there may be sort of more things added. So I think finding ways to combine everything into an efficient sales process that works for the customer as well as is practical for the product supplier is definitely a challenge. I mentioned already in a way the product availability that comes into it. I think the final thing I mention is also the level of detail in terms of exactly how you must disclose things. That can also become a problem because trying to define standardized formats and requirements across a wide range of products can present problems in making it usable for the customer. And I think that's something else to bear in mind when designing the requirements, especially the more detailed level. But maybe I'll also just highlight one of the, just to give an example of how complicated all this is. And I think while the industry, as I said, is fully committed to getting there and as fast as possible, and we've heard there are many, many challenges. But to give a sort of sense perspective, in terms of the CSRD, there are, I think, in the consultation for the reporting standards, I think something like 137 different standards, which would give a lot of information, which covers everything, and we're very much not in favor of a pure, emissions. So we want to go further, and the SFDR does go a lot further, but the CSRD goes even further now with the standards. Now, ultimately, we think most of that, if not all of that, is going to be necessary. But there is a question of staging and phasing in, both in terms of giving time to develop things to the necessary standard, but also then, of course, giving time for companies to implement. Now, of those 600, within that we have the emissions, the sort of well-known scope 1, 2, and 3 emissions. So those are 3 of the 600. Now, one of those is the scope 3. Now, scope 3 is one of the most complicated because it's your sort of indirect and secondary emissions. But I looked up how much guidance there is. Right now, the guidance on that is 180 pages on how to fulfill the scope 3, which is one of 600 potential data points. So it gives you a sense of how much we've got to go through. And I'm sure that over time, it will simplify, people get used to it, and there'll be more just general knowledge, expertise. But right now, it is a very big task for everyone, not just insurers, but the whole of the business industry and for consumers too. So it's a big challenge. We're up for it, but we shouldn't underestimate the complexity.
Thanks for being so clear. And so, yes, information overload or requirements overload for the industry is what I hear. But I think, again, in this in-between period where everybody's trying to get it right, it's maybe something a path we have to go through as we get there. Monse, can I turn to you? There are these new requirements coming in where we want to introduce the idea of asking the investor for whether or not he or she is interested in a sustainability product, which then adds on to the existing requirements, so it makes the life of the professionals even more complicated. How are you seeing these supervisory challenges? How are we going about this in practice?
Yes, no, I think it's a very, very important step that we're taking there in the legislative framework or in the sustainable finance arena, because it will be the first time that sustainable preferences of investors are introduced in the suitability test. The MiFID review came into force I think it was August, the 2nd of August, so it's just 2 months ago, and also we are waiting for ESMA guidelines to be published. So it's a little bit too soon or too early to gather or to have just clear conclusions from a supervisory point of view. But of course, we can spot a few areas where we have already identified main challenges could come from. So the first thing that I would say, and I think I'm echoing here some of what Alexandra also mentioned before, and it's been already mentioned in other interventions as well, that we need to be sure that investors and consumers, they understand the new terms, they understand what they are being asked for, and the concepts that the regulation are introducing in the suitability test. And this is not easy. It's not easy because it's not easy for us even to understand the questions that are established there. No? We sometimes mention as question A, B, and C, because it's really complex. So we need to find a way to explain those, or basically asset managers and the intermediaries need to find a way to explain in plain words the concept to investors. And that's important because if not, we might end up with two possible outcomes. One would be have investors deceived with the result in terms that they get a product that it doesn't align with what they were expecting for. So there's this gap between expectations and what they really get. Or even investors could just shy away from the market and say, look, this is too complicated, I don't care, just give me a regular product and I don't want to ask all these questions because I'm not really sure about the meaning of them. So there's a challenge there, and it's very important if we want precisely that all the work that we have done continues in a good way at the investor. And here I'm thinking about, of course, the retail investor and the end investor. What can we do? We have been mentioned, of course, the need to increase financial literacy, financial education, publishing some material and guidance, but I would like to emphasize the importance that for intermediaries and the personnel, the staff that is going to be giving the advice to consumers and to investors in the products, that they need to have sufficient knowledge to precisely to be able to explain these technical concepts in a plain way, in a very simple and clear way to investors. So there's a lot to be done there in improving the knowledge of the staff of the investment firms. And then I think also that there's a room for improvement in alignment as much as possible between sectors. I know that the different sectors, of course, they have different characteristics, that's for sure, but let's, as much as we can, establish the same guidelines or the same procedures in between markets, between investment services, between insurance sector and pension as much as we can. Of course, there are differences, but I think it's better from an investor point of view to have a simple way, but that the same way coming from different sectors.
Thank you, Montse. So we understand that it's extremely complex, that there are some huge challenges for professionals as they try to navigate this, efforts to try and put that in the forefront. But so, Alexandra, what's the solution? How can we make sure we get it right for the investors when they go into their bank or they go and see their advisors, to make sure that we don't lose them on this path precisely when we know that there's appetite, their willingness to participate in this transition, but how do we make sure we get it right from your perspective?
I think it will be very important to really take into account the answer to the last question. And it was not even whether the financial returns should go more hand in hand, but actually if they are more important. And I think really when we talk about sustainable investment products, we really need to remember that for investors, they're investment products. So they don't want to donate money, they really want to invest for sustainable future, better planet, but they also want and they expect pension adequacy. They really want value for money. And I think we cannot really discuss sustainable finance without products offering pension adequacy. And I think it's also a good link to the next panel. As Petra said, it's going to be discussing also inflation. And I think in the current environment, I think if the investors are kind of really very concerned about whether or not sustainable finance and sustainable investments are not going to offer them the value for money, they're simply not going to invest. So apart from understanding issues and being new to the whole concept of sustainable finance, positive, real, long-term, and I underlined this as well, long-term returns, because individual investors are really long-term in nature. They save and they invest for long-term goals, their pension, in fact, retirement, education of their children. So they are really interested in long-term real returns. And if I may also just comment quickly on the labels, because this is quite important, but again, from retail investor point of view, extremely important is that the labels given to sustainable investment products are really exemplary in current investor protection rules. Because in our research, we have also seen in the research on closed indexers, we have seen potential closed indexers being awarded sustainable finance labels from national jurisdictions. And probably there is no worse way to really erode further the trust of investors in financial markets as such, and especially in sustainable investment products.
No, thank you very much, Alexandra. I'll try to maybe summarize some of the key takeaways I think that we got from this excellent panel, and thanks again to the three of you for your excellent insights and proposals. I think there's an agreement that we are going in the right direction generally, that progress has been made, but there's still quite a lot that needs to be done. I also heard a lot of challenges in making sure we get it right, because we're still sort of in that transition path. Some very concrete proposals. So look at labels, but carefully. considering impact investments and making sure we can align with investor expectations and what the products on offer actually deliver. Considering also reducing the information overload, or at least being much more, listening much more to consumers, looking at consumer testing, making sure there too we provide exactly what they need and what they're looking for. Considering value for money and increasing education knowledge of financial advisors who are in the front seat in their engagement with investors. I also heard a lot of supervisory expectations, guidance, enforcement being there. So that's for us, we take away definitely. And there was also, I think, important points in terms of timing and the urgency, the need to be speedy in what we're doing, and at the same time, perhaps using the opportunity of the retail investment strategy that's coming up soon to make sure we put the consumer right at the center of that thinking and making sure we can make those adjustments or changes that would be necessary to make sure we actually deliver on the promise and the expectations of EU citizens in this space. So with that, I'm going to hand over back to Claire, but I wanted, please, can you join me in thanking our panelists for this excellent discussion. Thank you very much.
Thanks. Yes, thank you. A very excellent discussion. And now I can invite you to leave the stage. And as you do that, we are going to stay on the topic of sustainable finance and join Paul Tang, MEP, with a video message. Thank you.
I studied economics in the 80s. It was at the height of the Chicago School. Reagan and Thatcher were liberating firms from their shackles and set off a surge in profits. But times have changed since then. And today I can say with confidence, Friedman is dead. We no longer see companies and financial institutions as profit machines. The European tradition, with an economy that works for businesses and society, is back. Friedman is dead, yes, but we haven't buried him yet. And to ensure financial markets reflect the societal change, to turn corporates and financial into responsible citizens, to give them back their license to operate, sustainable finance is key. Sustainable finance is deeply European, and making it work for retail investors is a European responsibility. Because Europeans are united in their habit to save. While the average American saves 80% of their income, a European saves 25%. Europeans save more and have more to invest, over 4.5 trillion euros. Funds that are often invested sustainably. Together they've made Europe a global leader in sustainable finance. The green bond market is largely a European market. ESG labels are mainly European labels, and recently such labeled funds been doubling in size every year, from 288 billion in 2019 to 1.3 trillion in 2021. It's a European success story, or is it? Difficulties, because let's face it, it's not an easy time for sustainable finance. Financial markets are struggling to implement legislation on sustainability disclosures. Fund managers and insurers don't yet fully know how to understand, let alone act upon their clients' sustainability preferences. And all are struggling to understand the details of the EU taxonomy. Details which have been the subject of hot, heated debates and divisive vote in the European Parliament. And if businesses don't understand the rules, if politicians cannot agree to them, how can we expect retail investors to use them to put their money to good use? Or to trust that they're not being cheated when trying to invest green? Indeed, fears of greenwashing are taking hold. And examples of funds faking green are rife. So should we take a step back? Wait for markets to solve existing issues before moving forward? We need to move forward. I would firmly argue no. This is not the time to shy away from being bold. The urgency of climate change isn't reduced by political hiccups. Climate change doesn't stop because of data caps or tough implementation. And with every extreme weather event, be they floods or fires in the EU or abroad, we are reminded that this is the time to move forward. Forward with an ambitious strategy to fill the gaps, to change our economy, put Friedman to rest, finally to rest, and prevent retail investors being misled by false promises. And to achieve this, I suggest 5 gaps to address. We need to address gaps on data, regulating agencies, ensure accurate labels, focus on transition, and expand to social. That's a mouthful, but let me tackle them one by one. The first is on everyone's mind, data caps, because the financial sector has to report on the impact of their investments, without even their investment companies knowing this. The result, excessive reliance on data providers, who often use proxies or inaccurate data sources. But sustainable finance is work in progress. And here, progress is being made. With the Corporate Sustainability Reporting Directive, the CSRD, relevant data will soon become available, more available. And with the European Single Access Point, this data will be accessible to all. And I'm very glad to see the concept of dual materiality take firm hold in European disclosure requirements. Sustainability is not just about outside in or how sustainability risks impact a company, but also inside out, or how a company impacts sustainability factors. The disappointment was, however, that SMEs have been left outside the scope of these requirements, putting up barriers to their access to sustainable finance and keeping data caps in place. Going forward, also SMEs need the tools to disclose in a way that fits both their capacity and the needs of potential investors. Closely related to this is another area where transparency is lacking: sustainability rating agencies. One company can have widely different ratings depending on which agency you ask. Correlations of sustainability ratings for a single company are typically just 54%, while this is 99% for credit rating. Something is off here. The problem is no one knows what. Of course, it's a nascent market. Time is needed to figure out what works, which methodologies are the winning mix. In academia, you learn the importance of building on the work of others, taking what works, leaving behind what doesn't. That's the mindset that is needed here. That means full transparency on methods and data sources, allowing for others to take inspiration from what they like and improve what they think fit. Together with strong rules against conflicts of interest, this can form the basis of a new regulation. Relatively easy to write, we have the credit rating rules to inspire us and a game changer in the market of sustainability ratings. Many large institutional investors don't use the ESG ratings. They are mostly interested in the underlying data. Yet, for small investors, including retail investors, such simple grades are key. The same is true for fund labels, a third area in which we need to move. A simple label can help retail investors understand what fund to invest in. Recently, the disclosure regulation has been used to fill this demand for clarity. This regulation has different disclosure regimes. One for funds that say they pursue sustainability characteristics, Article 8. One for funds that fully invest in sustainable investments, Article 9. And a different one for all other non-sustainable funds. The idea is, if you say you're green, you have to show it. But frequently, the fact whether a fund discloses is taken by itself as proof of the fund's green credential. Instead of looking at what you disclose, the market only cares about whether you disclose. Given this widespread misapplication of Article 8 and Article 9, calls are growing for minimum standards to limit which funds can use these terms. Yet we shouldn't limit what a fund can disclose. By limiting the scope of funds that disclose how they take sustainability characteristics into account, using Article 9, we reduce, not increase, our understanding of a fund. It would be better to use these disclosures to find and fight clear cases of greenwashing. Funds where the name or the marketing materials don't match their actual policy, and I'm working to give the ESAs a stronger mandate to look into exactly that. At the same time, regulation is absolutely needed to detail what investments are the sustainable investment in which Article 9 funds are supposed to invest. But even with all the clarification in the world, Article 8 or Article 9 will never be the sexy terms needed to attract the billions of retail investments to finance the transition. Labels can take this role, but come at a cost. Because any label is by design a simplification, and I don't need to tell you that the sustainability impacts of a funds are a multitude of aspects, and difficult to grasp or to combine in a single term. What is more, labels easily become a goal on their own, just simply tick all the required boxes, and thereby stop being a means towards a more sustainable economy. A good label avoids this by putting sufficient responsibility on fund managers to think for themselves and by mandating a strong engagement policy to help investee companies become green, because a green fund cannot be static. Indeed, sustainable finance is not about being green, it's about becoming green. And this is the fourth point I want to highlight, because for too long now we have been stuck in the green corner, whereas we should be working towards changing our entire economy. The taxonomy is an essential tool that defines what's green, but we now need the tools that give companies incentive to move towards it. For this, two tools spring to mind. First, we have transition plans. They will soon be obligatory under the CSRD, and they'll be key to distinguish polluting companies that still have a future ahead from those with no place in a carbon neutral economy. The frequent verification of a transition plan is key, as is them being embedded in other EU legislation to ensure they are properly used. The second tool is the transition bonds. The European Green Bond Standard is a great proposal, but it will only incentivize investment in the small segments of our economy that is taxonomy aligned. We should also incentivize a move away from highly polluting activities towards more neutral ones. And the taxonomy provides a great framework for this. It has two borderlines, one for when an activity significantly harms an environmental objective, and one for when it significantly contributes to one. By creating transition bonds to finance the move away from the harmful activities, we can incentivize the move from bad to neutral, even when activities themselves are not green yet. The focus on transitions can bring together people's expectations of sustainable finance, the wish that their money does good, with what we need the most, money to help polluting companies change. Because the EU sustainable finance agenda will not work unless expectations match reality. No one is obliged to invest sustainably. They need to want it. And by focusing exclusively on climate, we risk alienating some. Our economy needs investment, not just in the transition, but in just transition. Therefore, the fifth point I want to address is the social one. Climate and social must go hand in hand. So we need continuously move the goalpost to integrate all aspects of sustainability, from climate to environment, to social and to governance, to ensure that a company that maltreats employees or that dodges taxes cannot be seen as sustainable, while investment in social housing are affordable healthcare are. As I said, sustainable finance is work in progress, and we're nowhere near done. That might seem discouraging at times, but hey, it's a massive opportunity, an opportunity to set global standards. Addressing the data caps, the regulation of ESG rating agency, it's an opportunity to give retail investors more ways to invest their money for good, including through clearer labels and fund names. And it is an opportunity to ensure that our concept of sustainability does what it needs to do. Focus on becoming, not being green, and on ensuring a just transition by putting social at the heart of sustainability. If we make progress on those 5 gaps in the EU's sustainable finance framework, data, rating agency, labels, transition and social, we can bring back the symbiosis between people and profits. Because what we're doing is more than simply classifying and datifying our financial system. It's to give financial markets a renewed license to operate. Much has changed since my doctorate days in the 80s, but for the first time I feel a big paradigm shift taking place. We can leave the days of Friedman behind us and replace it with a European system. For this, we should mobilize our savers who want to put their money to good use, because only when it works for all investors, sustainable finance can fulfill the European promise and create an economy where profits are balanced with societal needs. Thank you very much for your attention.
Some more interesting remarks there on sustainable finance. Now we're moving to our second panel, and I'd like to invite Fausto and panelists to join the stage. We're going to be looking at how to facilitate access to finance to consumers in an inclusive way in the current environment. And again, a reminder that we want an interactive session, so don't forget to use Slido with the code CPD22. So here are our panelists, and over to you, Fausto.
Thanks a lot, Claire. I hope you can hear me. Have a seat. So, welcome to this second panel, how to facilitate access to finance for consumers in an inclusive way in this current environment that was mentioned already this morning a couple of times. So let me introduce a bit the topic, and then we will start with some questions to our distinguished panelists. Financial inclusion means that individuals and business have access to a broad range of useful and affordable product, payment, insurance, investment, to meet their financial needs. And it's clear that the financial inclusion can help to absorb shock and can help to have a more resilient society. Though the greater is the financial inclusion, the more we may have effective national resilience against economic shocks. Now, it was mentioned this morning that this is a period of raising cost of living, inflation. We see this as a risk for people to reduce, to cut their expenses, to reduce investment, savings, to reconsider their pension plan. Just to quote an EIOPA study recently highlighting, for example, that the affordability of the price of Nat Cat product is one of the main reasons why there is so much low penetration of this segment of business in the population. So to enhance protection, affordability is one of the topics. And for sure, the economic environment nowadays does not help. Another study that we conducted recently at EIOPA as well talks about 20% of consumers that at least once in their lifetime they did not renew or did not buy an insurance product because of affordability, because of the price. High interest rate, to go across the... Okay. Just to mention other financial product, the higher interest rate may have consequences on the people, on the consumer to afford the credit product, to repay their loans. So all in all, we see the risk that financial inclusion can be an issue in this period. People can reconsider their expenses. They can have bad surprise when cashing their investment because of the inflation, because of the real return. So the less the real return are, and it was mentioned already in the panel this morning, the more we may have trouble and less inclusion. So this is the current economic context in which there is an evident trend in digitalization, which in theory, at least in theory, could improve, could go hand in hand with more financial inclusion. Digital distribution can reduce, for example, prices, can give people more affordable, cheaper product. There are plenty of examples for this, but also there are some, let's say, concern because data-driven business model and use of algorithms can actually go in the opposite direction, can tailoring the product for the best use of people can also maybe lead to some exclusion. It was mentioned this morning that people can have difficulty to be so digital, so it's maybe another barrier towards maybe the inclusion. So there are consequences from both sides, more risk and also more opportunities. As ESA, we have worked on the topic for already actually since a while. We produced a big data report in 2019. We concluded at that time that there was maybe too early to make any legislative changes, but clearly the benefit and the risk were visible, and the more we can try to harvest the benefit, the better for the society. So there are also other kind of, I don't want to quote all the studies that we did, all the work, also at secular level. And this is let's say, the challenge that we need to solve today. This is, from our perspective, the need for today's discussion. For doing this discussion, I have with me 4 excellent panelists, complementary in their background and experience. I'll start presenting Anne de Levensen. I don't know if it's the right pronunciation. You are the CEO of Generali Global Pension, a lot of experience in the field of employee benefit. You will, in a way, represent the industry, maybe?
Industry.
Part of the industry, but we don't have other parts, so you will. Esko Kivasari, actuary, already chairman of the Actuarial European Actuarial Association of Europe, and now finance Finland. So it's from the professional side, close to the industry, but not proper an industry representative, more the profession side. Then we have the academic world, Liz McFell from the University of Edinburgh. You published a lot of studies on insurance, data, innovation, insurtech, behavior. So you will today give a bit more the sense of the academic world. I don't know if you may be collocated between industry and but it's academic work. And then Olivier Uresalim, I hope that is nice, the pronunciation. It's a manager director of an NGO, Financial Inclusion Europe, so specialized in ethic, in sustainable finance and ethic finance. I mean, you are more on the consumer side, I guess. So it's, as I said, it's a well-balanced panelist. And before moving to the question to the panelists, I would like to actually hear from you, from the audience, with the usual Slido. If someone can put the question on the, yeah, that one. How does the current inflation environment impact the way consumers approach financial services? This is the question for you. Seems easy, but let's see the result. So the question is, I already see someone putting no impact at all, moderate impact, because some consumers may use less financial services, but in the end, most consumers will continue business as usual. Don't know, not sure, this is forbidden to answer the question. And high impact for most consumers, especially for vulnerable group, which I see actually is gaining the highest scores. I see around 70%, 80%, less than 80% maybe, but still quite the majority. And maybe it was not such a difficult question to answer. Good, so now we need to solve it, actually, because it's clear that there is an issue. Also, the audience believes that there will be an high impact. Olivier, maybe I can start with you for the first question to try to understand how to address the issue. Starting in this first part from the environmental issue of the inflation, the cost of living. So is it possible that this inflation will stay for long? What are your biggest concerns about it? And if there is, as I said, some real good scope for financial exclusion or not, what we can do as different stakeholders to prevent that this can happen and to help consumer?
Thank you, Fausto. So maybe first of all, I would like to start and to ask you a quite provocative question. Do you know any poor people, or a poor people coming from a family which was poor and coming from a generation which was poor for maybe 3 generations? I had the opportunity, I didn't know this kind of people, and I had the opportunity to meet many of them in some of my background, I would say. And I remember 2 persons. I just want to shed some light on these 2 profiles because I think it can color a bit what we're going to discuss afterwards. I remember Paul. Paul was almost just retired, little handicapped, taking care of his old mother. And at the time, I was providing microcredit, social one. And he wanted just to buy a motorcycle to be able to visit his mother and going back home, because otherwise he has to sleep on the ground of the room because it was not in the city center where we live. So he needed probably 900 euros credit. He has no saving for that. He was retired. Another person, Anne, she was single mother, 3 children, quite young. And she went there trying to find solution because she had a lot of very, very, very small credit. But so probably the total amount was not even 1,000 euro. But dealing with different debts, it was just a nightmare for her. And so we wanted to see if we can provide her a solution for these budget issues. So just if we keep that in mind, and going back to your question, Fausto, poverty and people living in very, very, let's say, low condition are quite numerous. I just checked the Eurostat data. I think they published recently the 2021, let's say, statistics on the people at risk of poverty. We are now reaching 21.7% of the full population in Europe. So the poverty and the risk of being poor is really a major cause of financial and social exclusion. And with this new trend and with inflation, the risk that the purchasing power of the population will decrease is really, really an important risk. The problem is, and I'm very happy that the poll just shows that people are already aware about that. Yes, for sure, financial services are not prior, at least some of them are not prior. Of course, some of them are absolutely necessary for the daily life, and I think about a bank account, a transaction account, but for the other product, let's forget about that. There is also another issue I'm seeing there. It's probably the insurance are not going to be on top of the priority, but, and we experienced this summer, and not only this summer, what are the impacts of climate change on people's lives. And for example, last year in Belgium, I think the flood that happened during summer led to very, very huge catastrophe. And among the people who lost their house, between 2,000 and 4,000 people were not insured with home insurance. So how to deal with this issue, how to find a solution, and maybe it's not only about the price, it can be, of course it is a part of the problem, it is also about education, it is about also different level of issues. So everything that can be done to protect and to increase the income of low-income people and medium-income people for the next years is extremely important to, let's say, and it's a very relevant policy measure to limit the negative impact on financial inclusion, which is a step for social inclusion, which is a step for defending human dignity. It's not only the barrier, the economic barrier is one of many others. And I think it's also important to mention that there are, let's say, room for improvement in different other, dimensions. I would mention something that has been already discussed, the complexity of the product and the complexity of the choice. It's not only the product, but it's about the choice. You don't need to understand how a car is functioning. It's not about that, but you need a clear way, an easy way to find the car that fits your needs. And so I think the complexity of the choice is very an important one, and also how the journey, the consumer journey that lead to find the right one for a vulnerable group of people is extremely, let's say, weak. There are no ways for people to make an easy choice and a clear choice for the product they might let's say, need. Another very big issue is that the market dynamic does not lead to a proper offer. So let's say for products that really are designed to fit the needs of people experiencing poverty. There are definitely very interesting products that can be designed in the field of insurance, but not only in the field of savings, that might help people on their daily base, on daily base to really fix some issues, such as I have to pay for 2 new jackets for winter for my children. I don't have the money. How I do that? And avoiding high-cost credit that you can get, of course, in some shops. Then there are all these issues related to the lack of basic knowledge, physical capability, to use more and more the electronic device you need to buy the product made available on internet. There is also the question of, is this product going to really, or this insurance going to protect me as I expect? This is also something that may, let's say, retain people to sign for an insurance. So if we want to improve financial inclusion, it's not only about, let's say, maintaining the purchasing power. It is a very important one, but probably the key one. But there are efforts to be done on other levels in the market. And just to mention Mr. Stiglitz, Nobel Prize of Economy, that has studied quite a lot the problem of information asymmetry between company and consumers. It is clearly mentioned that vulnerable group of people are more at risk of being exploited by companies. And just to say that with the digital environment and the use of big data and the way it's used to design new products and to market some product and to target some clients, it's definitely something in which I'm not sure I see for the time being any improvement for the vulnerable group of people to access better product, better design for them. For the time being, I'm still in, let's say, cautious expectation. Thank you for that.
Cautious expectation. I hope that you can hear me now. So you mentioned price, education, complexity of product, attention to the design of product for the poor people, for the most vulnerable one. So this also trust, you mentioned being an issue maybe. This calls for the industry to react. Anne, how do you see this input being considered by industry? What do you believe, in your perspective, industry can do to alleviate the burden of the inflation and cost of living? What are your solutions?
Thank you, Pedro, and thank you to ask me this question after the answer of Olivier. And as I said at the beginning, I just represent a part of the industry, and Why I mention that again is because when we think of financial inclusion, we have to make a difference between what is needed for everyone and specifically maybe for poor people in terms of living to help them to cope with the economic situation, and what is needed for someone, I don't know, preparing his retirement with a very high salary, for example, in a country in which the first pillar exists. So financial inclusion, which is a subject for all of us today, has many different aspects. So if we come back to pension business, because I represent pension business today, and I have no clue about what we can do to resolve poverty, which is something completely out of my scope. I mean, it's such a big subject. It's not the subject for us to, or for me today. So inflation, of course, and it was the answer, is have a huge impact on saving, on pension, and on wealth for everybody. And we have seen in the answer that it was not, at the very beginning it was 100%, and at the end it was not exactly 100%. So if we come back to the context, the economic context first, as Maureen McGuinness said at the very beginning of this morning, it's a very new context for all of us. It has been 20 years without this level of rate of inflation. It is fueled by internal and external factors, and we don't know how long it will last. However, we are quite confident that the normalization of the monetary policy can bring back a contained inflation in the next years. So this is one part of the answer, because we don't really know in which context we are. If we go back to the value for consumers, responsible pension funds, such as generally defined contribution products, the ones that you can find most of the time in second and third pillar, has been keen to offer net positive results after inflation on a long-term period. With rising inflation, we will propose more and more personalized life cycle investments strategies, because these strategies can offer, over 20 years and longer, a net return above inflation. This has been historically shown by several studies by Bocconi University, that you know, Fausto. In addition, we propose to our members more real assets, which is quite new as well for savings and pension. It's an increasing share of the allocation. Could it be real estate, infrastructure, or private equity? And this is an important step in ensuring that we have more participants in the capital markets, and very much in line with the objectives of the Capital Market Union that was mentioned this morning. This allows us to diversify the investments of our members, also based, of course, on their risk appetite. And this is where maybe digital can bring some progress to better assess their risk appetites. At the same time, European supervisory authorities maybe need to reassess the real level of risk for consumers over the long term, so specifically for pension, for example. Current regulatory frameworks, such as Solvency II or IOP II, can be over-conservative over times and need to offer a long-term perspective.
So you also call into the game the regulation and the need for adapting a bit the rule to the context and the push that we need to have. Yeah, it's not me, but we are all part of the game. No, we cannot simply say.
It's not new. It was even before inflation.
Yeah, on this we may have a different opinion between industry and supervisor, but okay. Good. Esco, maybe you have other answer to this question, and I also want to ask you, especially in the insurance world, with the way in which we price a product, and of course inflation will have an impact on the claims, so it will have an impact on the premiums to be paid. What is, in your view, the challenge that we need to face? How do we can ensure consumer will continue to invest in insurance?
Thanks, Fausto, and thanks for the invitation to this panel. So I'm representing actuaries more or less here, and if you don't know what an actuary is, then an actuary is a person who wanted to become an accountant, but he realized that he lacks the charisma needed. But anyway, Olivia asked whether we know poor people. I think I more or less know immigrants quite a lot. I've been taking Afghan refugees to my summer place to fish through the ice and learned a lot of those issues. And certainly when we think of the issue, then a measure for a decent society, of course, is how it takes care of the most vulnerable citizens. And therefore, there certainly needs to be an interplay between the state, there needs to be a role for the private sector, and there needs to be these public-private partnerships to take care of things. One of the things maybe I noted quite recently about the poverty premium was that I usually only watch streaming services. But I recently watched one movie through a commercial channel, and I couldn't help to realize that maybe more than half of the commercials were by payday loan services. So it's clearly an area that if you can afford streaming services, you avoid this, these products. But if you can't afford streaming, then you are in the commercial channels and you are preyed by such offers. About inflation, yes, really, I would like to make a distinction between inflation and living costs, because actually inflation is something like the value of money, and I think the European Central Bank takes care of that, more or less. It's of course a problem. But then living costs are a different issue. They are different for each of us. We have our consumption packages. Countries are different in that area. And there is really the issue that can be tackled. To some extent, this situation resembles the one we had with the pandemic, when there was the demand for different players in the financial sector to help with the pandemic. In banking area, it was quite easy because there were these counter-cyclical macroprudential tools that could be used. The Actuarial Association of Europe produced a paper trying to analyze what can insurance do quickly in this area. And more or less the result was that insurance is a slow business. There is no panacea from insurance that can be done here. And maybe the same applies to living costs. Insurance is still about, firstly, taking care of the risks and trying to avoid unnecessary risks. Then secondly, spreading the costs for the insured pool. And that's more or less all about it. Actuaries try to find out the actuarial prices for the premiums. Then there's the commercial side, of course, for the premia. And then thirdly, actuaries need to take care that enough money is collected to build the reserves to cover the liabilities resulting from the underwritten risks. What is happening in this area, I don't think very much can be done with inflation in this process. But what is happening, we are getting new tools to move forward with better data and so on. And there are threats, there are opportunities in this area, certainly. Better data, better tools, they make it easier to measure the risk. Well, maybe some risks become, so to say, insurable through this process because the data handling is cheaper, you have less overhead, if you do it well, you can increase what risks can be covered by the private market, even for the vulnerable populations. But of course, there are limits in that. The second area, certain with data, is you get to know your customers better. And the thing there is, what are you doing with this knowledge? Are you using it for the benefit of the customers to serve them better, or are you using it to exploit the customers and by knowing better? Then all these tools lead to better efficiency. Yes, this better efficiency in doing business can lead to benefits for the customers with better products, with better prices, or it can again just lead that you can operate in a better manner, but just reap the profits for the companies. And therefore, certainly there is room for, and certainly there is room for competition to increase in the area of insurance, and hopefully with competition give the benefits to the customers. The difficulty there certainly is what we see in many areas in financial services is that competition is tried to be developed through more and more regulation, which leads to compliance burden, which easily leads to the fact that the bigger players can manage the fixed costs of compliance, but the smaller players cannot, and therefore increased compliance burden might reduce competition and lead to something else that what was wished for. But I think actuaries are usually people who say that on one hand it's like this, on the other hand it's like that. And then there is the demand for a one-handed actuary who could say that how things are. I can only still have my two hands and say that this and that. Thanks.
Thank you, Esko. So it's part of the problem is unsolvable by the insurance industry, I understand, because there are systems that goes like that technically, and that's it. But you see at least a bit of light with the better use of data, knowledge of customers. Competition, let me say that on competition and compliance cost, we also have a principle which is the proportionality principle to help a bit, to face a bit what the risk you were mentioning, and let's use it.
Well, compliance works in some countries, in some others it doesn't really work.
Okay, tell us the country so that we can work as a European supervisor for better convergence. Anyway, the use of data was mentioned. Liz, I want to pass to you. You studied a lot digitalization, behavior data. What's your take on this? Is it really that we can enhance financial inclusion with the better use of data? Tell us.
Okay, thank you very much, Fausto. And thank you to my panelists. I'm not sure I can meet Esko's standard of jokes about sociologists. That's my background. I'm a sociologist who studies insurance. It's a very small group of people. But nevertheless, insurance is absolutely a social question, a sociological question, if it goes to the very basic question of how we share risks and how we pay for them in a society. And I think digitalization presents the biggest and most immediate challenge on the back of what has been a long, slow period in which risk appears to be individualized more strongly, the current is, than socialized. But I think, in my view, it is not necessarily the case that some of the most negative feedback around digitalization and insurance-based products that use AI and big data analytics, that feedback is public commentary is almost overwhelmingly negative outside the industry. I mean, if you read publications like the New York Times or the Financial Times, the critique of big data-driven tech industries as being extractive is almost relentless. And in the case of insurance, it's not necessarily always so well informed because these are really complicated products, and the industry and the regulators could probably get better at disclosing what is happening to people's data when they use digitalized insurance products. So I said that I didn't think it was necessarily the case that the concerns about big data analytics and questions of surveillance need necessarily be negative for the consumer experience. I think that there is a case for saying that the personalization in customer relationship management that is potentially equipped by AI and BDA is still somewhat underexploited. I think I love that Olivier started with referring to questions of poverty, and in particular, how many people in the room have direct, what sociologists would call lived experience of poverty. And I think when it comes to product design, that lived experience of what it is like to make a financial calculation, a product choice, when your options are very limited. I don't love the term vulnerable consumers. I think underserved consumers is actually a little bit better of a perspective because it puts the onus back on the industry to recognise that they have not necessarily developed products that suit consumers in those circumstances. And if you take products that fintechs have come up with that, for example, provide an intervention of collecting data that can compensate for a thin credit file to allow consumers who are outside of mainstream provision to access financial products. That's a really good example of a product that is targeted towards the needs of underserved consumers. More structurally, my father sold industrial insurance, so I have this concern, this interest in industrial insurance as a model that could inform the design of products in a digitalized culture, and that might seem really peculiar. But what industrial insurance, for those of you who maybe don't remember it as well, sold by companies like the Prudential, thrived on establishing a mass market presence among very poor consumers who were locked out of the normal provision. I think that's interesting because that succeeded on the basis of an ongoing conversation where the agent could suck up some of the causes of information asymmetry and compensate for that in the design, and feedback of product features like tolerating missed payments by default. In a cost of living crisis, designs which make it easier for customers to report struggles and duress. There's no reason why chatbots, for example, can't provide some sort of some sort of easier feedback. I think the thing to bear in mind at all times is that customers do not love insurance. They don't really want to buy it, and they will forgo it under stress. So the onus upon the industry to try and design products that are more lovable, that consumers feel more attached, more loyal to, is extremely high. So self-tracking and telematics products are good examples of products that could provide a way of enabling consumers to understand better what the deal is, what are they getting back for sharing their data, what are their benefits. But companies need to be perhaps clearer about exactly what they use the data for. And I say this partly to go back to the point that I started with, the overwhelmingly negative assessment of big data as a its surveillance potential could be tempered by clearer statements about what are companies doing with this data, what's it for.
So you see some light with using better data. Good. the distinction between underserved and vulnerable I found interesting, and also the call for design and design of more appealing product again is a call for the industry to innovate, maybe, no? Good. Let's listen a bit to the audience now. If you can put a second question for before we go to the second round of questions to our panelists. There is, we want to check with you, how does the digitalization of financial services affect the financial inclusion of vulnerable or underserved consumers? Let's change it. Digitalization can enable broader access, as it would lower delivery cost, and cost in general seems to be the one that is more supported, with something around 70% again. There is this 70% which is quite like before. 70% for the digitalization that is an enabler for broader access. This is a positive also in the view of our audience. Anne, again to you, again to the industry with the question about the use of data. How do you see in your experience this data is used? You represent industry, especially some part of the industry, as you said. There is a concern that this trend towards increased data usage can actually, as I said in my introductory remark, be a problem instead of a solution with the financial inclusion. Any governance maybe problem that needs to be addressed? What governance measure would be necessary in your view to address those risks and those concerns?
Well, for sure, governance is key, and once again, the answer of the people in the room is saying that it can be good, can be bad. Depends on how we use it, how we use this data, and what for. Is it to take an advantage on the consumer, as you said, or is it to give a broader access, as was the beginning of the answer? So governance is key because it's a direction, it's a balance that we have to find. And this balance, it's aimed at protecting the consumer and creating trust. Without trust, we cannot manage those kind of products with the data of the consumer. In generally, we have appropriate measures, and they are very important when it goes to big data, artificial intelligence, those kind of very sensitive matters. When it's only providing digital services to help to distribute, for example, the feedback of consumers is all the time 100% positive. For example, if I have in mind 3 examples of new defined contribution schemes that we launched, fully digital, with distribution or without distribution, it makes everything more easier for distribution, for sponsors, and for members. And there is no risk. This is just before we had papers, and we are people, and we had so many mistakes, and you know that insurance industry has a very good quality of service, of course, but it's sometimes it's work in progress. When you have a 100% digital product, you have a 0 default in terms of administration. This is a huge progress. I don't know exactly how it can be used to be more inclusive in finance, because it's kind of a different subject, but it's a progress, and it can help to include people because it makes things easier. So we maybe have to look at those subjects differently when it's AI and big data and taking advantage of data, and when it's providing digital services, maybe out of the data or not, to clients and members and savers and distributors and the whole industry, in fact.
So governance is the answer to enhance trust. Then maybe we should explore how this can be visible for the citizen, for the people in general. Liz, from your side, we know that some countries have taken a certain measure, no, to avoid or to limit the use of certain parameters. What do you think is this approach? Do we maybe set a threshold, some sort of line for everybody to be taken here, or is not yet the case?
Yeah, despite all its difficulties, I think so, yes. I mean, the discussions earlier today, continually referring back to the need for clarity, even amidst complexity, and the enthusiasm for labels, again, even amidst the complexity of what's being labelled. I think there is a huge problem across the sector with facilitating public understanding, particularly in a rapidly changing context of the regulation of financial products, that most of the buyers don't understand what's being bought. And if you couple that with what I said earlier about the degree to which tech innovations generate a negative reception, there is, I think, a powerful need for companies to be clearer about what they're actually doing with the data. And I think that applies because people will think the worst in any case, so it's not necessarily as reputationally damaging to have clarity about what, for example, self-tracking data is used for by companies, and to make that explicit. So in the US, which I'm not an expert in this area, but from my perspective, the US, in California and in New York, there is a more specific and detailed baseline definition of what insurers should not be doing with alternative and external data. And somewhere along those lines, despite all the kind of jurisdictional differences between different territories about what they do and do not allow, for example, a company selling self-tracking products to do with that data, whether it can be used to price risk in particular. I think the widespread assumption that if data is collected through self-tracking measures, it will be used to price risk, needs to be corrected or challenged or modified. The very idea that alternative consumer data is used to price and has been used to price is, it's like dark science. It's obscure and creates suspicion. I think some complexity might need to be sacrificed in order to produce a clearer understanding, maybe even a label.
But sacrifice complexity maybe is a good. I see someone in the room. They want to make a question.
No, I would like to make some remarks, observations, share some observations if possible.
Okay, maybe we have 20 minutes for question in the end, so I will give you the floor. Okay, then no, because I saw one hand raised. Let's move to Olivier. Your take on which measure we can adopt to ensure have access to the product. Do you see different in the product that you mentioned poor people, you mentioned basic products that are absolutely needed for people. So I guess you have a sort of ranking of the different products needed. What we can do if there is let's say a sort of mandatory product to be given. Already this morning we heard about some basic needs. What do we do?
Well, just before to start to answer directly, but I really would like to react to the poll, just the response. I really enjoy the fact that it is mentioned that, well, digitalization has the capacity to potentially improve, let's say, the design of some product and the way it can reach the needs of a more vulnerable group of people. But altogether, that it might not lead to a better offer for this vulnerable group of people, which is, as an economist, something that is, for me, absolutely shocking, because an efficient market should lead, if there's a demand, to be, let's say, completed by an appropriate supply. And it's not happening. So this is something on which, in my view, regulator has to intervene. So this is my first point. Of course, I'm going to come back on this. But naturally, I would say the competition in the financial services does not lead to appropriate product for all the demand, even if some of the demands, you don't have so much low-cost product or low-cost, let's say, insurance in this particular sector, and other sectors as fixed and fixed solution naturally to adjust to some demands. Anyway, having said that, I had the opportunity to conduct different research and surveys in the past, and usually we're not, let's say, targeting people in, let's say, experiencing issues, but more the professionals who are working on daily basis with them. They are the ones that are more easy, I would say, to identify and also to survey. And they consider, of course, well, of course, because I'm of course convinced about that now for years, that not having access to some financial services is definitely a barrier for financial inclusion. Okay, but financial inclusion is a necessary step for social inclusion. And if you want to go a bit, let's say, beyond this idea, it's then really part of human dignity. So this is very important to acknowledge the fact that not having access to some product today that are becoming so much necessary for your daily life is really a barrier for your inclusion into society and your capacity to live a dignified life. So, of course, and I'm very happy to hear Commissioner McGuinness mentioning the Payment Account Directive and the particular articles related to inclusion, the right to access a basic payment account is definitely one of the stronger decision and a stronger regulation to protect and to provide consumer with, let's say, some rights. Having said that, I want to be a bit provocative then again here because I consider that it's mentioned for consumers. Okay, well, but inclusion is about people who don't access consumption. So it's also for the non-consumers who would like to become consumer. It's a detail, but it means that it's not only consumers, but citizen, or is it citizen, or is it, and this is a bit provocative, people living in the European environment. And people living in the environment are not always official resident or are not always official asylum seeker. But, for example, as regard the Payment Account Directive, as regard the capacity to transact, which is definitely the necessary step to start whatever inclusive life, become challenged by digitalization and the cashless society. So the answer to maintain cash is a very important one. But if the cash society is purposely, let's say, there also for maintaining people in the non-digital world, to allow them to still live in a society that is digitalized, it's not the right answer. The right answer is to provide digital tool to all people. And I know it might not seem compliant with the anti-money laundering regulation, but it is to understand that the way this anti-money laundering, let's say, regulation has been designed and the way the liability has been put on the shoulders of financial institutions, in my view, is not really appropriate. And having said that, what is important now, and we can use digitalization to fix the problem, is that with this digitalization, with let's say some particular let's say biometric let's say parameters, we can avoid, let's say, some risk of money laundering with people who might not have all the documents to prove their identity with the proper way, I would say, the way required nowadays by these regulations. So I invite, it's a political issue, I'm sure, of course, but I invite, let's say, policymakers and the society as a whole to consider how you can start to live a dignified life with no means of payment that has the digital, let's say, dimension nowadays. And so cash is necessary, it's a complementary. So back to the other kind of product, I'm afraid because of the success of insurance industry, yes, there are insurance products that are becoming absolutely necessary to live a dignified life and at least to be protecting against major risk that might lead you to experience poverty, homelessness, or getting long sick, let's say, situation, are handicapped. So these products are very important. And so motor insurance, home and family insurance, health insurance are becoming extremely important to guarantee is a financial and social inclusion. The problem is, and I mentioned that at the very beginning of my answer, is that the market dynamic, the competition, does not lead naturally to an offer for vulnerable group of people. So, in my view, what should be done is to design default option product. This basic product and this basic payment account is a good first example of a solution. And what could be very interesting to consider is that these particular products that might be not so profitable as others for the companies, for the industry, should be developed in some ways to define, to be designed in some ways that all the industry take part of the effort on a proportionate way. So it should not be unfair that why, for example, the postal bank, let's say a public one or related to public one, will be the one to provide this social product. So, of course, it solves the problem of accessibility, but when you don't have a choice, it's not fully inclusion. You know, you access to the product that is delivered for all people. It's not really having a choice among different offers. So this basic product, in my view, should be developed in such a way that the whole industry is liable and take part to the effort. Finally, I would like also to mention that I'm very much concerned about the risk of being retired and poor. And I really don't know what you think about that, but definitely, in my view, the best way to guarantee that we won't become, as European poor people once retired, we need a very strong first pillar. Are we agree with that? Thank you.
Yeah, together with also a second and a third pillar strong enough to support the first one, maybe. Esco, thanks a lot, Olivier. Thanks a lot of good point. And this is again a call for this design, the default option. Actually, there is a default a product which is quite simple. It's named the PEP, and it started recently. Let's see if it will fly. Esco. Talking about data, there is a recent statement. EIOPA is publicly consulting against certain practices on, let's say, using price in a way to, let's say, take market share, offering low prices, and then increasing it in the year to come. It's called technically price walking. We are basically a misuse, what is in our perception, a misuse of data. It's one of the cases where supervisory action might be needed, at least. We are consulting publicly. I want to see your view on this.
Okay, thank you, Fausto. Maybe I start first. Liz was boasting of a long history in insurance with his father being involved. I can boast even from a longer history in insurance, as I have inherited lots of letters. And this is a letter of my grandfather from 1913 to his fiancée. And maybe this is also one part how products could be made lovable. So the quote, "I believe that I may yet again be able to sleep once I have drunk Amor's potion of love from your velvety soft lips. My, oh my, how empty is the life of this young man. I do not think I could have borne this autumn of such harsh love, of such relentless love, had I not taken up work in life insurance. It is in this work that I have poured all my sorrows, in this work that I have immersed myself in for hours, thinking of nothing but our company Salama and its foe, Suomi. But when insurance work does not come easy, when the soil feels too barren to cultivate, that is when I regret that I have ever allowed such a thing to take my mind off the throes of love." Well, that's history. But then about today, yes, about setting prices and how to get along with those. As I mentioned, actuaries do the actuarial basis, but then there is this business side of charging the premia. And certainly there are different ways companies react to this. And it is, as I said, it is important to have good competition, because that is really what should guarantee the best products and the best prices to customers. So maybe the problem is how to have good regulation in that area, not to take competition away, but of course try to guide industries for good practices. As an actuary, I do not like the idea of premium optimization or premium walking, price walking, as you might call it. But then again, I understand that there are these business ideas of how to set prices. Liz was saying that insurance usually is not lovable, and there's the saying that insurance is not bought, it is sold, which means that often there needs to be incentives for customers to start to get insured. It's the first hard step. Then the second hard step for a customer who already has insurance is whether to stop the insurance, because then you might end up in a situation that your cover stops today and you have tomorrow the loss, and then you of course feel sorry for that. So I would be cautious in how to tackle the problem, not to kill competition in the area. That should work for the best of the customers and everybody, but still still to avoid excesses in how things are in that area. Certainly the idea or the background of better data, modern technology, is that traditionally we had very scarce data. It was expensive. We didn't have the data. It was expensive to get the data. It was expensive to handle the data. Everything is improving in those areas. There's lots of data. The technology is cheap to manipulate the data. You can do lots of things with the data. The thing is then to understand the causality between the data and the losses, and how to have the best factors in that area. And certainly there is much work to be done in that area. I think actuaries have in the history made lots of mistakes in the area of mixing correlation with causality and doing this and that. And that's the reason why I say that actuaries should be involved in getting us to the better world, because we have already made all the mistakes and others don't have to repeat them.
Thanks a lot.
I see someone wanted to, yes, maybe someone can give the microphone to the audience. Please. I understand it's not a question, it's a comment, right? Go.
Yes, some observations as such. I'm just an ordinary consumer and I'm happy to be here and be able to kind of share my observations at this point. And they're kind of, I don't know, I'm very naive and I'm not educated in that area. But anyhow, in terms of the kind of pension funds, I would like to say that it was kind of, before there was the defined benefit, and then there was this change to defined contribution. I can't remember the year that happened. Can you enlighten me a little bit on that? Anyhow, from the point of the industry, I think it was a genius move. And now I'm kind of over-interpreting because maybe this move had this unintended consequence or collateral damage of inflation even, I don't know. And then a comment to the actuary profession. And I think that maybe you learned, you were educated before the introduction of the Excel tool, and what influence did the Excel tool have on the actuary profession as such in terms of manipulation? But it's very philosophical, sorry. and the third remark about the data availability for the insurance companies, then still the question of data ownership. I mean, that train has left the station, but actually the citizens should own the data as such. So very philosophical, sorry, and thank you for the opportunity.
Thanks a lot. Not so much philosophical in the end, don't worry. Anyone want to comment? I have also a question from the audience in the pipeline. Any comments on...
Maybe on this one, that about the defined benefit and about Olivier's comment of first pillar, I very much share the ideas of Olivier in this area, that to guarantee decent pensions, first pillar is crucial and important. Usually I think first pillar is attacked by economists, but Olivier is an exception. Thanks for that. And then about the pooling issue, actually I think what you meant with like pooling certain risks, I think we have examples of that in motor third-party liability already now, when there are actually motor third-party liability is insured by private insurers, but then there is the need to form a collective pool for at least uninsured vehicles, and I think that could form some kind of a blueprint. I don't know whether I understood completely what you meant with that, but that might be a blueprint to develop your thoughts in that area further.
Well, if it's just a discussion a bit now, well, it can be a way to fix that, but I'm not really sure. What I have originally in mind is more about designing specific products that very much fit the need of vulnerable group of people and people with low income, because they don't have the same needs. And what is good with low income people, and sorry to be cynical, but they are very numerous. So it can be good to include them as a clients as well, because you won't be able to make any money with no people, but with poor people, maybe it's possible. Sorry, I'm a bit cynical here.
But also your idea on the support that we can all give as an industry, but also maybe going beyond. EIOPA has worked on this, what we call the shared resilience solution, so it's something that can be taken. Liz, any comment on the data ownership of our, no?
I probably would make a philosophical comment, which I'm not sure is very helpful, but I don't really go along with the sense that it's the customer's data per se, if you think about some of because the data is transactional. It occurs in the space between the provider and the customer. So it's data often that would not be trade if it wasn't for this product at the other end. You wouldn't be creating a world of data if you weren't transacting with Amazon or wearing an Apple Watch. So data isn't this thing that comes out of your body. It is something that occurs in the relationship. I don't know if that helps particularly, but it does complicate what it means to regulate this data and to understand how to secure it and be transparent about what it's used for.
Yeah, if I may react on this, I think there is, and ESCO won't contradict me, but there is a kind of elephant in the room here is about the data precisely, and in particular the one that are used to, let's say, assess the risk as regard the insurance company. And let's speak about non-life insurance. We had very, let's say, interesting discussion, let's say that way, on what are the proper rating factor to be used to influence the price. And there, I think this is really something that is on concern, because a lot of the data used is to potentially assess the risk of claim. And this is very important. This is all about the insurance industry and how to be precise about what we need next year for the claims. But mainly, the data are used also for helping targeting the clients that are less risky, and mainly the competition between insurance is more based on how to get more of low risk profile in our portfolio than the other, which does not lead to a better offer for all. That's one of the key problems and I'm really focused on this, for the products that are becoming necessary for people to live a normal life. So they are not all insurance at all. There are only few products. But for these one, I think the mechanism of competition should be changed.
Now we are going really philosophical, maybe, but some good input. Esco, if you can be brief in reacting, because I want to ask you something about how to. I see a question here. How we can help people understanding risk of not taking risk in this current environment. I don't know who wants to jump in, but Esco, please react, and then.
It's always dangerous to ask me to briefly react to something, but the question was very philosophical. Let me try to be quite condensed. I think there is the psychological level of risk firstly, which is clear that the purely scientific idea of risk is different from what people think about the risk and what they are able to pay. And that creates some room of maneuver to not be really exact in pricing. Rather, maybe that helps in that direction. Another issue in this is that, Liz, you mentioned the individualization that is coming with data. Maybe that is, I don't think you thought like that, but in some papers it's been said that big data and AI destroys insurance because we all become individual and it becomes like certainty. But I think as an actuary that insurance is not about, insurance doesn't insure probabilities. It insures the actual outcomes, and the actual outcomes are still based on probability and not individual certainty. Okay, let's. I studied in the 80s when we still had a Soviet Union, and we had in our university we had exchange with Soviet scientists, and there was one who said that probabilities are an issue for capitalism, but in full socialism or communism, probabilities disappear because everything will be certain.
Anne, maybe you want to jump in on the risk, not taking risk. How we help our people, let's say, to understand the risk of not...
This is a very, very good question. And maybe before that I can answer to the DB and DC defined benefit and defined contribution comment that you made. So today, if you look at assets managed for pension worldwide, maybe half of it is for DB, half of it is for DC, and DB is decreasing a lot, of course, because nobody is now able to take on such amount of liabilities, and DC is growing. And the question, it's related to this question that how can people in charge of taking decisions for themselves, for saving or for pension, if they don't take risk on a long-term period in an inflation context. It's, of course, the result of that is more or less well known already. It will be impossible to beat inflation if you don't take risk. And there is a second element, which is economic slowdown, because we always mention inflation, because now we are in inflation, but economic slowdown is this second stress, in which it will be very difficult. If you only have inflation, you can take risk. If you have inflation and slowdown, very big slowdown, and market turnout, it will become more difficult. Maybe the only answer is education. We have to educate people, and you stressed that yesterday. It's really up to everyone, because it's a personal responsibility. It's more and more a personal responsibility for people who are included, of course, and not for people who are excluded. For people who are excluded, there are it's solidarity. It's not a choice, it's different. If you have a choice, it's that you have tools, you have money, and if you have money, you have to make your choice with your risk appetite.
Thank you. Let me check if there are other questions in the... Yeah, I see someone. Two, please. Microphone. Keep your hand raised, because otherwise they will not see you.
Yes, thank you very much. Thank you very much. My name is Christian Gülich from the German Association of Insured. I would like to come back to Olivier's idea, which I like very much. He spoke about the basic standardized products which should be offered to everybody, and of course by using the digitalization. I think digitalization is really essential for the implementation, for example, of standardized pre-contextual information requirements. For this is a very good means in order to implement this. And I clearly think this has mainly been realized already in the non-life sector, by offering, for example, basic tariffs and premium tariffs. We see this in house owner insurances, or of course car insurances, and so on. But it is not realized in the life insurance sector. And Fausto already mentioned it. It is the PEP, where still there are no offers, or maybe there's one offer, we do not know. At least officially there are no offers. And I really would like to ask the industry representative simply, why don't they offer it? And one of the points, or one of the questions which I have is the industry in fact simply afraid of being enforced to give too much information disclosure on the products? The products are very complex. We all know they are classified as package insurance products, so they are linked to the PRIPS regulation, the ITD regulation, and so on. So there are many requirements already in place. But I think digitalization is one means to give consumers the chance to really understand the main features of the product, and of course to realize the main information, especially pre-contractual information, for example, on costs, on past performance, on performance scenarios, and so on. So simply, why does the industry not take this possibility to show that it is possible to make such a product?
This is for you. Anne, this is for you. I know that why not offering a PEP first?
Why not? You know that in the PEP you have 100% fee cap, and at the same time, mandatory personal advice. Even with data, even with digital processes and things like that, for now, it's still difficult to find an appropriate business balance, something which flies, as you said. So, and we'll see. You said we'll see if it will fly. For now, we haven't found the solution.
There is a review clause anyway that maybe will tell us how to adjust the regulation if really needed after 3 years' time.
Yes.
We need to wait a bit, but let's still hope that it's coming. There was another question. Yeah, please go.
Good morning. Thank you very much. My name is Fernando Herrero from ADICA, Spanish Consumer Association in Financial Services. Financial exclusion has become a matter of concern of the EU. The problems of access to basic banking services are various: digital barriers, changes in the banking sector, branches, ATMs, everything every day less. More expensive basic banking services are some examples. Among the tools adopted by the European Commission to address the problem is the basic payment account. However, in some countries like Spain, its extension is very limited. It's a great unknown for the people, for consumers, due to the null interest of the banking system in offering things. Don't you think that the industry should assume a more committed role in terms of financial inclusion? Since is the industry, is the changes in the industry that generate the risk of exclusion? And the second one, I fully agree with Oliver when he says that the solution is not, the solution lies in achieving the digitalization for all. I think it's a very important thing in terms of financial inclusion also. Don't you think also that the industry should help, especially in the cost of this digitalization for all? Thank you very much.
Thank you. I don't dare to give the answer to ESCO now because the time is finished. Maybe Leeds, you can comment. Also because I don't. It's not fair to always ask Anne to reply to industry need. So I'm looking at the other side now. Leeds or Olivier?
I read it as a question for Olivier.
Well, to be honest, I'm not sure I really get the point, but for what I understand.
Do you need the point to answer?
No, yeah.
No.
No.
ESCO is forbidden.
No, but for the basic services, and let's see if it's about the efficiency of this measure and the way it has been implemented. For sure, there are still quite a lot of let's say margin of improvement, because while from a country to another there were quite different, let's say already history. In some countries, this basic account and this right for basic account exists for years or decades. And so we learn a lot in these countries about why it does not work and how to fix that. Mainly it's because it's not publicized, and so people don't even know that it exists, so they don't ask for it. Another interesting thing is that what we observe, at least in some countries, is that the company adjusts their offer. So in such a way, they don't need to present these basic option because they don't refuse anymore to open an account because they are at risk of being imposed a basic account. So they have designed, let's say, alternative product, which is, in my view, quite a good and relevant response from the industry. So I don't know if it exactly fits your questions, but that's my contribution on it.
Thanks a lot, and the time is finished. I know Claire reminds us we are now going to have a nice lunch, but before the lunch I can ask all of you to thank our panelists for the lively contribution. Thanks a lot, really.
I had to.
So two, when we will be tackling the subject of open finance. So enjoy the lunch break. So, welcome back, everybody. I hope that you had a good break. Delighted to kick off this afternoon with our third panel. What are the opportunities and challenges related to the access and sharing of data in financial services? Don't forget, interactive at slido.com with the hashtag CPD22, also our Twitter hashtag. But now, François Louis, over to you.
Thank you so much for this introduction. And as Petra was reminding, I mean, the bar is so high now after the previous two panels that we are really stressed here, and I'm wondering what we can bring to this very lively discussion that we've had this morning. I think we've been touching this morning on what finance could bring for the sustainable transition that we need, and also how we could, in fact, go after individuals' personal needs also. I mean, not only for gaining access to finance, but to get access to a better dignified life, as Olivier was saying. And I think now, I think the purpose of our panel is also to see whether with open finance, we could help bridge some of those gaps that we've seen and discussed this morning. So what could open finance bring into this broader discussion? Could that be a way of, in fact, broadening up and the use of finance and making sure that it can fully fulfill its purposes for society? This is, of course, a little bit of a continuation of all the discussions we've had before on open banking. And here at the EBA, not myself necessarily, but my colleagues in particular, they've been very busy during the years 2016 to 2022, trying to come open banking into life. And I think we've reached now a situation where it's been very well embraced by customers, by the industry, by fintechs also. So we've had a change in the way payments are operated. And still, as the commissioner was telling us this morning, there is still a big gap. There are still so many people who don't have access to payment accounts in our Europe as a whole. So this has been an improvement from a sort of competition perspective, access to finance, also probably from a security perspective, with the new developments and the new entrants, we've probably been able to reap a number of benefits from recent innovation in the area of payment systems. But there are also shortcomings that probably need to be addressed, especially now that we are thinking of broadening up this experience and enlarging it to all sorts of financial sectors and areas. And so we will be discussing that today with a very distinguished group of speakers. Let me introduce them in alphabetical order. That helps, of course. Rim Ayadi is professor at Bayer's Business School and chair of the EBA Bank Stakeholders Group. She's playing a very important role in our institutional setup in that context, advising on the work of the EBA. Magda Bianco is the head of Department Consumer Protection and Financial Education, Banca d'Italia. Hetal Popat is director on open banking at HSBC. And Agustin Reina is the head of Legal and Economic Affairs at BIUC, the consumer organization, so well known. So, with this, let me introduce the panel. We'd like to start with a couple of questions that we will show on screen in a second. And first, we'd like to go with the experience of PSD2 and ask you, and I'm not, yes, here it is. We'd like to ask you directly, have you ever used those new payment services that came across with PSD2? PSD2 services have given consumers the possibility to allow regulated firms to access payments data held by banks, showing information from multiple accounts. And this is a massive no. Okay. So that's interesting. Then, I mean, I think that leads us probably to start asking questions about the representativeness of the sample. Which is always an easy way of circumventing the outcomes when we don't like them. Okay, so I think we don't need. Okay, that's very good because I mean the second question was also predicated on the expectation of that type of answer. So I can go on now to the second question, which is, if you've not used that so massively, why is that for? And here we list a number of possibilities. Is that because you don't know what this brings? You have concerns about privacy. You don't know how to do that. You don't know which institution is responsible for sharing your data. And it seems that the question about not the privacy anymore, but now what they are, how can I use them? I cannot see the benefits for me personally. That seems to be dominating, but followed pretty closely by concerns about privacy. So it's a lot about not knowing so well what it is, where it is, and how that could be used, but also related to privacy concerns, if I read it right. And I think that's probably something which is a good starting point for our discussion today, because we tend to perceive PSD2, as far as we are concerned, as something that was extremely helpful to improve competition, to sort of keep the incumbents on their toes vis-à-vis the new entrants, also leverage on new technology, and revisit a number of the old concepts. So we tend to see, and also improve, as I said before, security. But as we see, there is still some way to go before those types of services are really mainstream for our populations. So I think the first question I think we thought we could discuss today, and I would like to ask our panelists is, what do you think really PSD2 and the opening of payment services did bring to the industry, and what are the challenges more specifically that you would expect from open finance now, looking at what we've been having in recent years as a result of PSD2. So what exactly are those challenges that open finance could bring to us, beyond what we say usually, okay, which is okay, we just enlarged, this data sharing on what people do with their insurance and securities transactions on top of their banking transactions. So what could that bring to the players, to the customers, and what are the challenges we should have in mind? And I'd like to turn to you, Hetal, to start this part of the discussion, so that you can give us the viewpoint of the industry.
Yeah, Professor Louis, firstly, thank you. Can I reassure the audience, you are actually completely normal. The data you just saw about yourselves is actually pretty representative of our customers across the different jurisdictions. So right now, for open banking services, we see around about 10% of our customers are digitally active customers, are using open banking in retail. For SME businesses, it's higher, it's nearer 20 to 25% now. For corporates and high net worth customers, very low. And they're unusual types of customers where different digital services may be more relevant. So you're very normal. So that's a good starting point. And the reasons you gave also, the reasons you gave are also normal. If you'd been asked the same question in 2019, when this all came to life, security would have been by far the top reason why people were cautious. More and more people are seeing themselves or have colleagues and friends who've used open banking services, and so security is starting to come down the list. Plus they're confident if their bank is doing it, then it's probably okay to do. But now they're saying, well, how do I use these and what's in it for me? And those are good questions. I'll give you an example from me for just this week of how it was useful. My family are about to move into a new rental property. Typically, the vetting process for that would be to submit a whole bunch of bank statements. In one click, by clicking on an email, I was able to share or open up a link to my bank portal, authorize the sharing of my bank statements in real time, and within a couple of minutes, my tenancy was confirmed. So as a consumer, at no cost and very little effort, I was able to do something that would previously have taken a whole bunch of effort. I'm happy. There's value for me in doing that, therefore I did it. So sometimes it's about having the use case or the event happen in your life where that service is offered to you in order to tempt you into trying something new. And hopefully all of you will have those soon. This is a nice use case because the other party here is the landlord or the letting agent who would normally have received a chunk of paper. That requires cost and effort to screen. In doing it through open banking, the reference was validated through algorithms in the background. It confirmed the income and expenditure matches to the rental, and it's all done. So there's real value for both parties here.
Can I probe a little bit on that, if that's okay already now? So, I mean, I do see the convenience of it for sure. I mean, that's pretty clear. But now, if we say, okay, let's go to the next level, and we say, okay, this information that you've submitted in this new, more innovative, more efficient way can also be shared now with hundreds of financial services or non-financial services providers. Is that also okay for you? Are you fully aware of this?
So, that's not quite true. PSD2 is very clear. The firm with whom I've shared that data has no rights to onward share it without disclosing that to me. So here within the EU, we have some of the highest standards of data protection in the world, and customers are protected against these risks. But do they understand that they're protected? Is that clear to them? Maybe not, and maybe we need to explain that to encourage them to use these services for their own benefit. That's an education piece that may be there for government and public sector. It may also be something that we need to build on in the private sector in our user journeys and the flows and the screens that we show people. But it is controlled. So if we take that and say, where does that take us next? I think there's a couple of key lessons we have from PSD2. One is that there's an 80-20. PSD2 was relatively expensive to implement, and some of the most expensive things to implement were the things that aren't being used. So making a single immediate payment through a SEPA credit transfer isn't very expensive to build. International payments, with all the complexity of currencies, sanction screening, and the other elements that go with that, are much harder. So industry has spent a reasonable amount of capital investing in journeys that so far nobody's using. What they really wanted was the cheap thing, which they also have, and is being used now. So if we look towards open finance and where to go next, I'd say we need to have a way of identifying what are the priority use cases that will be used in the market and generate consumer benefit, and focus our work there. Because open finance is 10 times the size of open banking. We'll make the problem too big if we don't prioritize and sequence ourselves correctly. I think the second lesson we had from PSD2 is that there's a need to communicate more clearly with end consumers so that they start to use these services. Because as we've just seen, many of us don't fully understand them. And this is a relatively informed group, I would suggest. And I think the third lesson, which I know the EBA certainly has talked about quite openly, is having been a global trendsetter and done something very new, there were lots of rules that were quite prescribed, but there were other areas, for example, what type of standard is required, which were left open to the market. And those took quite some time to be properly settled, and they slowed down implementation and the delivery of benefits to our customers. I think the European Union is genuinely a global innovator in many areas, and PSD2 is one of those. And one of the downsides of being the first to move is you learn from your own mistakes. If you look at what's just been done in Brazil, they've taken all the good things from PSD2, all the lessons, and have iterated it and made it cheaper, easier to implement, faster to gain customer benefits. So as we look towards open finance, I'd say there's a piece of work that's needed to look at what have all the other jurisdictions that follow the union done, because there's lots of good ideas out there.
Thanks for that. That's really helpful. Maybe can I continue 1 second with you, Hetal, still? I mean, working at a financial institution, a bank in particular, so how would that help you, open finance, to customize or to tailor what you want to offer to your banking consumers?
Yeah, I'll give you a really simple example. And this talks to the financial inclusion agenda we discussed this morning. So one of our key objectives, of course, as a financial institution, is to lend to creditworthy customers. For new-to-bank customers who don't have a checking account with us, our success rates on unsecured loans are relatively low, because typically they've already been declined for credit, by their existing main bank. So they may have a thin credit file or some other feature in their background which makes it slightly complicated. So these poor customers have to go to many, many different institutions in order to get a success if their main bank has already said no. Or they have to start going down to the higher cost near prime and subprime lenders. We've implemented open banking data collection as part of our credit journey. 75% of customers choose to share their existing bank statements from other banks with us via that route, rather than do it through statement upload or some other mechanism. So 75% adoption, I'd say that's extremely good 4 years in. And our credit approval rate is 5 times better than if they don't share the data that way, because we've got enough information that we can make good choices. We're not trying to relax our credit standards, we're trying to make sure customers fit inside those. But more data helps you get more people in, because many people fall out because there's not enough data. Another good example, I think, is on ESG. One of our competitors, I won't name them, we never promote competitors, has a service in their mobile app for SME customers, which uses their transaction history. They've worked with an external recognized party to convert that into a carbon score. Now that's imperfect, because what did I buy in a supermarket? It could be anything from tobacco to bread. So there's a lot of assumptions in that. But it's starting to help customers understand their carbon consumption and starting to help them turn that into things that they can action on a day-to-day basis. Now, if you added more data sets, which is where open finance comes in, if we could have the transaction history from the retailer added into that, so you could see where did this €100 really get spent, then you could make that much more granular.
Well, thanks a lot. That's really illuminative. And the opportunities, I think we start seeing a little bit better what could be the opportunities for the customers. But now turning precisely to the customer's view or consumer's view, Agustin, I mean, what would that be from your perspective? Is that a sort of unbiased or like totally positive view from your perspective, or are there also challenges or threats that we should be worried about, or that we should certainly tackle when implementing such a scheme?
Thank you. I think we need to start from where we come from, which is open banking. Open banking started, with the idea that we had a market that was not competitive. We needed to open up, or either we open up the market or we break up the banks. That was kind of the logic at the time. It started in the UK, and then it came to Europe through PSD2. So the whole logic was to address a market failure. And from our perspective, yeah, it's working, because there were measures in place to ensure that this happened in a safe manner. One example of this was the strong customer authentication, so on and so forth. When it comes to the open finance discussion, the narrative is slightly different. We don't talk about addressing market failures. We talk about innovation, stimulating innovation in the financial sector, but also ensuring that people are under control of their data. So of course, from the innovation point of view, I can imagine that there are a lot of opportunities. If you think, for example, financial entities being able to access, let's say, climate data in order to optimize insurance products, or banks being able to access the data related to the energy efficiency of buildings in the context of to provide green loans. But what happens when we talk about personal data? And this goes to the other point, which relates to people being under control. And we wonder, what does it mean in practice, people being under control of their data? No?
So the commissioner said that this morning.
Yes,
he was very strong on that. I mean, that people should be in full control of their data. But then we heard in the context of the panel that data could also be considered as transactional data. So that means that there are two people that are involved, not only one. What's your view on that?
But the question is, what does it mean being in control of your data, being in control of every single data point that you generate, and being able to say who access to that data or not, and for how long? We are talking about potentially hundreds of thousands data points in your life. Yeah? So do we talk about being able to have very micro choices about how your data is being used? Or we need to rather look at what is the reality. of consumers, how consumers are actually right now exercising their data rights, which unfortunately it's on the basis of a take it or leave it scenario. So when we talk about open finance and opening up the accessing of personal data, I'm not talking about any other type of data, which I see that there are merits for that, as we have been seen in the previous two panels. But when it comes to personal data, and there are three consequences of this. The first is that basically you are increasing to an unimaginable extent the transparency of the demand side. So what happened? Here's a room probably full of economists. What happened when you increase the transparency of the demand side? You can optimize prices. In other words, you can apply personalized pricing. This is something that the commissioner also mentioned this morning. No? And optimizing prices or applying personalized prices in a market where switching rates are extremely low. So it's more likely that someone will get divorced and they will change banks. And in a market or in markets where consumers present behavioral biases. So consumers tend to accept what is presented to them. And in markets that are extremely complex. So if we combine all these three elements, there's basically potentially a cocktail for a disaster. So when we talk about open finance, we say, yes, we can see the potentials, but let's make sure about the choices that the regulator will make, and see how that potentially will not only affect people's privacy, but also the dynamics of markets, let alone when we talk about opening the financial services sector to companies that already hold a lot of data, because big tech will have an interest to enter in these markets as well. And they don't have the best record when it comes to complying with competition, data protection, consumer protection laws. So what would it mean not only for the consumers, but also for the entire financial services sector to have these new companies entering these markets?
No, thanks a lot indeed. And as you said, the market dynamics or structure could even itself evolve as a result of those innovations and change that we bring into it. And that leads us probably to, so we've seen the two sides now. I mean, what it could be from a financial industry point of view, what it could also be from a consumer protection point of view. I'd like to turn now to you, Magda, and hear from you what from an authority, competent authority in charge of consumer protection, how do you see that? And what are some of the early challenges that you could see, for instance, from a security and protection of the data perspective? Do you think that consumers, agents, economic agents are sufficiently well aware of what they'll have to do or to agree to? Or how do you tackle that on the ground also as a competent authority?
Okay. Well, thank you very much first.
An
easy question. Let me start maybe again from the open banking experience into the open finance one. As we've seen also from the survey and then what Hopal was telling us, we have to recognize somehow that the benefits of open banking, at least for final users, which is somehow my perspective, are growing, but somehow are still to be fully realized. Customer involvement, direct customer involvement is growing but still limited. It varies a lot across countries. We know UK is forefront there, but for example in Italy the number of account information service calls is limited, even more limited payment initiation services calls. And if we look, for example, at surveys asking customers whether they are willing to enter in this market, we see that their availability, their interest is related to trust, so security issues, to wealth, in a sense, their income. There are wealthier people who are more interested, who have more than one account, and their level of financial education. So in a sense, this has implied that up to now, the opportunities for inclusion have been only in what we economists call in the intensive margin and not the extensive one, meaning more inclusion for those who are already included, who are already banked, more services, more interesting ones, maybe cheaper ones, but not for those who are unbanked, for those who are outside. And we know from the previous panels that in Europe there are still unbanked, in some countries quite a large number. Now, what allowed the positive evolution up to now, I think, in general for digital payments and also for open banking more specifically and in perspective, the great attention to security issues that allowed to increase trust, up to a point, of course. The consumer protection in terms of liability rules in favor of consumers, that I think increased trust as well, which are two things that I think really show that it is very important to govern innovation with a specific attention to final customers, both consumers and also very small firms. Because, well, we know innovation is good. It might produce a lot of competition, which is good, but we know that there are market failures, so this is not enough. We have to think of how to direct innovation. So, for example, we know now that we need specific financial education for a more substantial adoption. We need to overcome other weaknesses that I think we see, the issue of standardization, of application program interfaces, the asymmetry between incumbents and newcomers, I think is an issue. Now, all these issues, I think, play a role in thinking about open finance. Open finance, as compared to open banking, has, of course, huge potential for inclusion. Being extended to other segments of the financial sector, but also beyond, utilities, mobiles, and so on, they are potentially a great source of inclusion for those really unbanked. And we have experiences of emerging and developing countries which are jumping to open finance rather than going through open banking. Brazil is an example, I think Mexico and other. Of course, they are just starting now, so we don't really have too many lessons to learn from there, but that's very interesting. So there are opportunities, there are huge challenges, of course. First, we certainly need to think of the same level of protection or even more in terms of security than for open banking. And I think Augustine raised that. I think consumer protection really needs to go towards what we call protection by design. We really need to force the design of products that are really in the interest of consumers since the beginning. And with open finance, this will be a major issue. There will be a lot of risks for consumers, things just of cross-selling of products and so on. Financial education would be a huge challenge there, but it will be even more essential, and we can discuss more in detail there. Another big issue for us will be cooperation among different regulators, and not just financial regulators, but even beyond. We now already have issues with data protection regulator, but then with open finance it will become really more complex, and we will even have to think of how to do enforcement, how to use technology to do enforcement in a much better way, and probably regulation will have to be more flexible. And I think we will need to think about asymmetric rules. The open banking experience in Europe with the asymmetry probably pushed for innovation, for entry of newcomers, but it created huge risks. I think with open finance, we really have to think carefully about asymmetric data exchange, sharing.
Let's come back to that maybe in a second also about are there specific data sets that would deserve some specific treatment or would be a bit more even sensitive or that could be shared in different ways? Let's come back to that maybe in a second. Before, I'd like to ask you, Rim, you've probably been discussing that also in the context of the EBS Bank Stakeholders Group, which brings industry, academics, and consumer protection representatives, but also as an economist, what's your view on this topic? So from a financial intermediation perspective, so are we going in the right direction, or are we just losing a little bit the raison d'être of financial intermediaries in the first place, or are we just making everybody a financial intermediary now? How do you see that?
Thank you very much, François-Louis, for this very important question, because currently we are living a digital revolution which has started already in terms of the data collection, the data methodologies, and how to use and how to bundle the data, not only financial data of customers, but also beyond this. And this can be easily connected and linked with other sets of data. So this is, for me, the most important to also keep in mind, that nowadays it's not only about the collection of data of consumers or customers of banks or insurance companies, of investment funds, but also how you can use it and bundle it with other types of data using, for example, internet or, for example, other methodologies of big data, machine learning, artificial intelligence. Nowadays, for example, if I look at the research disciplines, we are using this, and it's very easy for us to get to another layer of information, which is interesting for research, for public policy, or for public interest. Now, when we go into specific data of consumers, and then, of course, we are opening this, what I call before, it was the core of monopoly or oligopoly of the banking sector. Nowadays, we are opening it up to other players, which are what I call them the third-party players, or whatever these are called. But who are those players? Are we able to map them? Are they licensed for this type of information? And this is what is important also to keep in mind, because at the end, the information that banks have before, it's the core of their business. In fact, what is the business of bank is to collect data on consumers, on borrowers, if we go back to the old ages, and then try to use this information, screen it first of all, so there is an information creation there in the value chain of information, and third, to monitor it. So monitor it also means that we're getting further information about this customers, and also eventually, because of relationship banking, face-to-face is important too, to get further knowledge about the customers, and then embed it, which I call in the soft information, not only hard information, but also soft information. And this is value. This is the value of financial institutions, in fact. Nowadays, all of this, it's changing, disrupted in reality, because, of course, the asymmetry of information, for me, is there, still there, but then it's becoming much more complex to understand and disentangle. So who is really owning, or at least managing, or having access to the different value chains of this information that they own? And this is a little bit complex from an academic point of view. Of course, we can argue that before the financial industry was mainly oligopoly structure, and this is also because of the data ownership and the data information on the consumers they have or customers they have. But we are moving into what I call a contestable market where the barrier to entry and to exit are very low, which is good in theory, but in practice, what does this entail for the consumers and the customers of the banking industry or financial industry as a whole? And for me, I cannot give a clear answer. On one hand, I like very much competition, higher contestability, transparency. You mentioned transparency. But at the same time, we have to be aware that this transparency also brings complexity to customers. And these customers, they might not be able to handle even their own data for many years. So, and we need the trustworthy organizations to allow those customers to be, in a way, protected. Now, again, financial education is fantastic, or data education. Now we have to be thinking about data education, how to use it. It's fantastic. But at the end, this is not all about education, because sometimes you cannot ask somebody who is, for example, first of all, he doesn't have the time to deal with all this data and all of this information. So there are what I call other risks that we need to deal with then. For example, the misuse of data. Even sometimes the customer could even misuse his own data. How? For example, to bundle it with other type of data and not knowing exactly what this data is going to be used for example, for marketing purposes or for other purposes. And then find himself, in a way, part of the process of at his own detriment, without really knowing what's going on in that sense. And this is, we need to understand, at least to screen and be able to deal with it via regulation. Now, you mentioned PSD2. PSD2, in principle, it's a great opportunity for the market to become more competitive. And also, we need to think on the protection side very much for the issues I mentioned, for example, security, or all these data platforms, which we don't know who is owning them, or maybe nobody is owning them. how they can be hacked, they can be misused, and we've seen many episodes of this aspect, which we need to pay attention to. So I think I see very clear trade-offs between competition. Yes, we need to have a market that is competitive, but at the same time, we need to understand that there are serious security and stability issues that we need to think about. And beyond this, we have the incumbent, I mean, banking industry or banking players, but there are other players like Google, like, I don't know, all these newcomers that are coming, and they own huge amount of data. They were prepared for many years to collect data about everybody. When they have financial data about customers, they can use and bundle, and they can provide everything. Now, if we trust them, that's great. If we don't, we will see what happens in the future, because I believe that we are going into much higher frequency of crisis, and then we need to deal with it as we dealt with the COVID.
So on this positive note, maybe we can move on to the second round of questions we wanted to have. But maybe, Rim, still immediately, sorry for stopping you in your glass of water, but you said we are moving into a more contestable market. But still, my initial reaction would be also that still, I mean, there are such economies of scale and scope that, I mean, this contestability of the market may not be so often met, right? No, what do you think? Or, I see you want to react also.
Because I think that links what Magda was saying about the need for asymmetrical legislation, and where we are seeing more need for contestable markets, for more competition. At the same time, the regulator, the legislator is thinking how to generate that. And the right conditions. And we have, for example, in EU law, now the Digital Markets Act, asymmetric legislation. We have the Digital Services Act, asymmetrical legislation. The Commission put forward a proposal for the Data Act, which is also very close to this discussion. Who cannot access the data of connected devices? The gatekeepers that are designated under the Digital Markets Act. So I think we need to think much more in terms of asymmetrical legislation in order to be able to create the conditions for markets to be more contestable. And then if I can just complete something that you say I found it interesting. In relation to competition and the trade-off, the thing that we need to be clear of is that competition is not an end in itself. It's a means to have better product, but I would even go even further, to steer the economy to where we want it to go, to align it with the values that we as a society consider as important. So I think that more than ever, we need to start thinking. And when it comes to open finance, at least it's not clear to me where do we want to see financial markets in the future. And if this instrument is aimed to bring forward these markets to somewhere, well, at least it's not yet clear to me where is that.
Okay, so maybe one first reaction could be, I mean, one topic we could discuss. For instance, with PSD2, we've seen that the amount of payments fraud has decreased tremendously. So there are a number of side benefits which are not negligible, like this one, who came about with PSD2. So what could be the positive externalities that you would be expecting from open finance in the first place? I mean, from very, very technically perspective, is there anything you would identify as something that would mean that the system as a whole is safer, more secure? Hetal, any views on that? Maybe I have a second, slightly, maybe this one is not so inspiring. Are there technologies available that would allow us to facilitate this control that the customer should retain on their data?
Yeah, so I think I'll take the second question because it's easier. So there definitely are. Digital identity is progressing at different paces around the world, and we're seeing that. But there are less technology, but there are frameworks that we're seeing in different jurisdictions. Singapore, for example, has probably moved the furthest in this direction, where it has created, based on a national identity scheme, it has linked first public sector data, healthcare and taxation, now bank data, their open banking is all connected through that same portal, and customers have full control over it in one place. And it actually brings a number of benefits versus what we have with PSD2, in that in one place through Singapore's GovTech portal, I as a consumer can see which of all of my institutions I've connected, and who's accessing. Whereas with a PSD2 many-to-many network, I would have to go to each of my banks separately to see who's accessing their data, based on my permissions I've provided historically, but I certainly forget things, I'm sure other consumers do too. This provides a single repository where that's all available, and in a very easy-to-use way. So as we move from open banking, which was relatively simple, to open everything, you need some way of identifying who am I. That, in my view, has to be a government identity. That has to be the ultimate definition of who I am as a digital citizen. And then everything can hang off that place in one way. Anything else, to me, seems to be fraught with risk. There'll be many commercial actors who'd want to hold those keys. I'm not sure, as a consumer, I would necessarily be a fan of that.
Agustin, from a consumer, again, protection perspective, so how would you set the bar in terms of the expectations? So what should customers be entitled to ask from their financial intermediaries?
What a question.
That's the purpose of this panel, right?
When we talk about financial, open finance, so it potentially affects every single financial product. So from insurances, to investment products, your pensions, payment, banking. So, and we need to think what will have the impact, on people's daily life. And if you think of the day have 24 hours and people have very busy lives, to start thinking about all the permissions that you give today and permissions that they will stay for probably the years to come. So I think that of course, all these solutions that are being delivered in the market are unavoidable, and then in the market also because there is a demand. That's clear. But the question is, where do we set the lines about what is, acceptable and what is not? And here we often hear about, in Europe we have GDPR. Yes, we have GDPR. We're all very happy with GDPR, but GDPR has its limits as well. This is a baseline legislation, and the financial services sector is very specific. So the question is whether we don't need, which I think we should, have tailored solutions for the financial services sector. Imagine what could mean that companies that already have a lot of data about you will be able to access data that they don't have yet of you, and which is probably the most important data that somebody can have, which is all your financial history, all your financial decisions, which give a clear profile of yourself. So I think from that point of view, we need to be really, really careful about how we're going to approach the open finance discussion. And then just to go back to the question of the remedies that was discussed at the beginning. I said that if people are informed, and something that we have identified in these markets, but also in other markets, is that disclosure remedies have a limit. People have a limited capacity to absorb information. So through disclosure, through consent disclaimers, we are not going to be able to solve these market failures, which relates to the limited attention that people have to process all this information, which are likely to increase even more with the implementation of open finance.
Yeah, sure.
Just one small, I think, perhaps contrary point to what Augustin has just said. So far, big tech hasn't entered the open banking PSD2 ecosystem, and they definitely know about it. So that tells you something. We can be scared of something happening, but for some reason they're not. Perhaps it's because they don't want to fall inside conduct supervision. That's one theory. There may be other reasons. I think the second thing I would just draw attention to is, in reality, I suspect Amazon knows more about me than my bank. And that's true for anyone else who's a Prime user, because you do everything with it, right? And that's why they have it. It's a genius system. They charge you, and because you pay for that, you then do everything with them. So they're charging you for the privilege of giving them all of your data. That's a business model. And equally, Google knows everything about us already, if you're a Google user, which, my children think to Google is a verb. They didn't know there's any other way of looking for things. So would giving financial data to those firms materially change the data profiles they already have on digitally engaged customers? I'm not sure it would, actually. But I do completely agree with the point around personal data that you made at the very start. If I think about insurance, personal healthcare data is a very special category of data, far more sensitive than your transaction history for most customers. So there are some types of data within the financial system which actually aren't the financial data. It's not the payments. It's not the investment holdings. It's the other stuff about your life that we collect as financial institutions in order to provide you with financial products. It's the contextual stuff that Rim was talking about. That, to me, is the really sensitive data. And that's the reason why financial institutions are regulated for conduct, because we do ask so many questions about your lives. And I think we need to be very cautious about how that data is exported.
So I think it's really interesting because we seem to be progressing now in the direction where there are different types of data, right? So there are purely transactional data, I mean, like your day-to-day behavior, but there are a few things which might be a little bit more sensitive and that you might be covering in a different way by regulation or supervision also. So Magda, how do you react to that? So any type of specific protection needed for certain types of data?
Yeah, well, following this conversation, I think, well, it all leads to go very slowly, take our time before moving from open banking to open finance, in a sense, or at least be extremely careful and think about all the possible consequences when we regulate. And the other general thing about when we deal with this market is that we need to have different tools altogether. We need a very well thought and strict consumer protection issues. I was saying before, we have to go towards protection by design, I think, and regulators have to work on that. We really need to have also individual protection tools. And I was saying about redress mechanisms. As things get more difficult, more complex, we really need to make customers more trustful that if something goes wrong, even if there was a regulator that tried to imagine everything that could happen, but nevertheless something happened, they have something easy to address the problem. This will become more difficult as different markets are put together. But I just want to bring the Italian experience with the redress mechanism in the banking sector and in the securities sector. We have an ombudsman, a very simple ombudsman, which costs almost nothing. And it worked very well with payments. Because, of course, even after PSD2 and all the security issues that were there were a lot of cases of frauds. And the redress mechanism helped a lot in creating trust among customers and certainty on the market, because it dealt with the issues very quickly. Now, after some time, another redress mechanism for securities was born. And now we have to find ways to discuss among ourselves, because there are products in between, and that is an issue. And this will become even more necessary if we expand now. An insurance ombudsman is being created, so the three of us will work together. I think that's one thing that we really have to build. So a second instrument. The third, I think we cannot avoid dealing with financial education. I know it looks like, well, the customer has to do this. It's not like that. We have to build effective digital financial education programs, because even if we set up all the mechanisms to protect consumers, if we have strong customer authentication, if then we have a vulnerable customer who provides the data, we cannot do anything there. So we need to do something. This is a huge challenge, because we have to deal with behavioral biases and with data requests coming from all over. This is a major issue. We have young people who are really ready to offer their data without great embarrassment. So we really need to address this. I think working in this, the challenges are huge, but we have greater knowledge, greater instrument about methodological issues, how we have to build effective financial education programs. We have to start from children in schools, but that's somehow easier because they are easier to reach. But now the urgency is adults. And there, what we have to do is to deal with separate segments of the population and address them specifically. Look at their specific needs and use the most useful tools. So for those who are not digitalized, we really have to use also traditional instruments, media, whatever, and so on.
Can I ask you a follow-up question on that? Because we've concentrated so much so far, mostly on, okay, how do we avoid that those people entering into those approaches are not getting abused? But how do we check also on people being simply discriminated just because they don't have access to those modern and digital means? And so the ombudsman's mechanism that you were referring to before, so would that be something that could be used as well, a bit like a whistleblower mechanism? And would you check also with firms, or how could we check with firms that they are not discriminating against certain types of populations?
Well, that belongs first to supervision, banking supervision. We really have to deal with that, to address that. In our case, we should specific communication to the market, that they have to be really careful to vulnerable, and they have to deal with different capacities or vulnerabilities in offering their products. In a sense, in Europe, we have the product oversight and governance guidelines that are already something we can work on that. But then, of course, on the other side, we have to work on financial education with really different instruments. We have to reach people through what we call translators, intermediaries. For example, in our programs, we work a lot for migrants, and we use either schools for migrants or intermediaries, NGOs who work with migrants. And of course, they reach them with different instruments. They deal with them directly, personally. So we really have to adapt the instruments to get to everybody.
I think it's probably a very important point that we simply don't use the traditional contracts or information channels, or the type of documents we use simply and convey them or just share them in a digital way. But we also inform people differently using the new technology, so that they better understand the consequences of what they are transacting on and what they might be accepting to share.
Yeah, and we know now that for adults, for example, for adult education, we have to work much less with information and much more with interaction, making context situation and presenting the consequences through evidence of what they are used to or what they might be involved to. So we have something more about methodologies. It's hard. It requires a lot of energy, a lot of finance to get deeper into this. But we know a bit more, so it's not a lost cause, I think.
That's good to hear. Rim, you were nodding, so any...
I just want to agree with what Magda was saying, and even go beyond. I think we need to go to another step of consumer protection at EU level. And this, I remember many years ago, when on the retail financial services debate, I think it would be good to start building a European system of consumer protection, even to try to move into more harmonization in that sense, because we will see the market is becoming much more complex, and then most probably you can have a system of ombudsman in all European countries, but the levels eventually of really dealing with those complaints might not be the same, or at least at the minimum level. I think in these aspects we need to go into a maximum level harmonization, and eventually it's time to start debating, for example, to have a European system or European agency for consumer protection. I think the US has one already. They are not so advanced as Europe in the debate of open finance and all of that, but then the Asians are very, very developed, and other countries too, like you mentioned others, Brazil or Mexico as well. I think we need to go into that approach and learn also from other experiences, see which are really the main risks that are, I mean, these are all risks which are shared by all consumers or customers in the world. So I think we need to know a bit more and how authorities have dealt with it. I think this is also something which we need to learn a bit more. The market is going very fast, Magda. I think if we go too slowly, then we are taken over by market developments, and eventually now big players like the big tech and all these big players that have been preparing for themselves for many years, unless you cap to a certain extent where they can be active in the European Union, for example. That's possible, that's hard, but that's also possible. I don't know. We should think about this type of thinking, because you mentioned, Augustine, when at the beginning, when, okay, we opened open banking to deal with the problems of large financial institutions. But probably now we need to think a bit further how to deal with the other players, which are very big, bigger than banks, and sometimes we need to think in that sense as well.
Sure. Maybe just want to react on your comment on having a European approach, which is probably music to our ears. I mean, the fact that we are the three agencies organizing this event together every year, I mean, also gives you a sense, I think, of our common approach and willingness to make progress. I mean, at the same pace in all three areas. You wanted to react.
Actually, on that as well, which is this idea that once was mentioned at the beginning, the supervision and enforcement convergence. The fact that now markets are so interlinked. And let me give a very, very practical example. Crypto advertising and promotion. That you guys have been really busy, basically telling people, stay away from it, be careful with where you put your money. But at the same time, what do we see is that in social media is flooded of advertising. No? So then we started thinking ourselves, how do we address this problem? Because MiCA is not yet in place, so the ESAs don't have powers to intervene, let alone a product level. So then we look at what is available. We have unfair commercial practices legislation, which is kind of baseline legislation regulating commercial practices. So we say, okay, let's try to activate this. But this is not in the competence of the NCAs, neither of the let alone the ESAs, but of the consumer authorities. But the consumer authorities are not necessarily thinking about this problem because, of course, consumer markets are so vast that there are many other problems out there. So how can we actually streamline enforcement to be able to tackle these problems that are happening now? Because we cannot wait for 3 years until MiCA is in place to be able to regulate, crypto at distribution level, while we already have something in place that we can try. And there, I think, is where much more coordination at the European level will be certainly desirable.
I think that's a very fair point. I'd like to come back for a second on a topic which is consent. And you mentioned that, Hetal, with your example in the beginning, saying, I mean, my information, I mean, all those documents I've been providing, they cannot be unshared with someone else without me giving my consent. And I think that's also something we've been struggling with PSD2, for, I mean, the sort of refreshing or giving newer, I mean, confirming that access could be, given for another period of time to some third-party providers. And that's been seen as, on the one hand, something that would protect the customer or the bank itself, but also something that was slowing down a little bit the take-up of these new services. So where do we draw the line here, in fact, in terms of this consent thing? I mean, is it something, how do you see that? I'd be very interested in hearing your views, I mean, the four of you on that. Is it something that we say, okay, I mean, I'm informed in the first place that my data could be shared with others, I'm fine or I'm not fine, and then, but anytime I want to check, I can get access. I mean, is that something that would be acceptable, or is it more like every time those data are shared with certain types or any type of other providers, I should say yes or no? How do you tend to see those lines? Because for me, that's one of the critical questions. We say customers, consumers, agents should remain in full control of their data. I still have a hard time to see how we make it in practice.
Yeah, it's a great question. And I think you have to come to the use case. What is the customer trying to achieve? Or what's the provider trying to offer the customer? So my first example for tenancy, that's a one-time request. On the day of my application, they are looking backward at my last 3-6 months of data to say, does this individual have the affordability for this property? There should be no ongoing request. And part of the reason for having TPPs as regulated parties is they have a duty of care to understand the use case and make sure they're offering the right service. So that should be a one-time request for an appropriate historical period of time. They should not be allowing a provider, my rental agency, to collect data for the next 6 months, which will be allowed soon under the law, because for that use case, it's not necessary. And data minimization is a principle that applies across PSD2 and comes across from GDPR. So I think we do have some of these principles already in place, enshrined in law, and we shouldn't forget that. But for a different use case, for example, we have 20% of our small and mid-sized businesses use open banking. That's primarily to share their bank data into accounting platforms, Xero, Intuit, and the like. They do not want to reauthorize that every single day because they're running an operational business, and the whole point is this takes away manual work for them so they can focus on running their business and do less administration. So I don't think you can have one size fits all. I think you have to have a legal and regulatory framework that has properly regulated parties working with the consumer who have a duty of care to make sure it fits. And I think actually PSD2 has done that. And I think that's part of the reason why we did it. I don't think it was just because banks were big. I disagree. I think it's partly because we already had these third parties screen scraping in the market. We saw risk already there. To Reem's point, the market does things by itself, and it was right to then bring that into a regulatory environment and put some of these standards in place. You also don't need to always have explicit consent. So it may be that instead of having to force the customer to go through a digital journey every period of time to reauthorize sharing of data, you can have a long-lasting consent, but remind the customer, by the way, you are still sharing your data with these firms. There's ways of presenting the information to customers so that it's actionable and they can stop it if they wish to, but do so in a way that doesn't automatically kill a service that they may be enjoying. There's different options here.
No, that's probably a very realistic approach, saying, okay, depending on the situation, there might be different ways to go about it. Are there any reactions on that, or shall we? Yeah, I see you. No, I see a smile, which is probably an encouraging smile.
No, I think that markets can be also more complex, and something that we have identified is that when people consent to the collection and processing of data, there are so many clauses which say, yes, but this data, we might need to keep it for that reason, or you agree that we might share this data with third parties. So not only the regulatory, but the market practices are so complex that even asking the consumer constantly whether you agree to continue sharing this data is going to be announced. And as we discussed before, people tend just simply to accept things just not to be bothered. So how do we conciliate the fact that we need people to be in control of the data by asking them, do you want to share your data? But at the same time, with the fact that actually people are asked to share data or to decide whether to maintain a certain consent policy. So it's really a catch-22.
So listening to this, that might be one way also for regulators to think in terms of, okay, what is the necessary level of transparency, and how do we make sure that this level of information is digestible by the consumer? There might be also different shades of granularity, saying, okay, I mean, you can have a quick sense of what you're sharing, or you could go more in depth and get the full Monty of what you're sharing, and so on and so forth. Then I'd like to take a question also from the audience.
I think we need to understand a bit more the psychology of the customer as well, in that sense, because I think more research on this is needed, on the behavioral aspect, to better understand why a customer, for example, he's saying, yes, I can consent sharing of the data, because maybe he doesn't understand what this means, and he doesn't know, She doesn't know what this data is about. So sometimes they are running to open an account or doing certain things. They want to go faster, so they just, yes, I consent. So it's also, we need to better understand why this is happening and learn from the market development practically.
If I may, yeah.
Sure, Magda.
I think that's very right. We would need a bit more information on that, surveys or analysis, because if we could understand better what is the reaction depending on what is offered to them, we might work a bit more with default rules that are, say, on the more protective side, so that you can go beyond the default rule, but being aware of that. But of course, to do that, to fix the right position of the default rule, you need to know more about how typically people react depending on their characteristics.
So that means we should keep asking the question we asked in the beginning and get deeper into this and see exactly what are the drivers. We have one question here on screen, and then I'd like also to open up for questions, from the audience. Any comments from you on how it might be used for suitability, know your customer, financial planning?
Because I was kind of thinking from the beginning of the conference about this, this question, because I didn't know the question. But the whole
so that was you asking the question.
Financial advice at the end of the day. No, it's not my question. About financial advice, and I was wondering how then all the discussion on open finance, then fits. In the current, not only regulatory framework, but also practices in financial advice. And in particular with the problem of conflicts of interest. Because here we are increasing to a significant degree the transparency of the user, while we are not addressing the problem of conflict of interest in financial advice, which relates to the question of suitability and consumer preferences. So I really am struggling then to see what will be, how the consumer can be put, or the retail investor, in a better position with such a high degree of transparency from the demand side, combined with the conflict of interest on the advice side.
Or at least there is a reciprocity needed in terms of better understanding what are the...
But at the same time, we know that consumers and retail investors, as a matter of fact, rely on the advice, because these products are extremely complex at the end of the day. So that's something to look closely.
How does it make the problem any worse than it is today? As of today, I've got a financial advisor who's collecting information about me. Just because I automate the process and make the suitability assessment quicker, today it takes an hour, which is a very boring process for any consumer who's been through it. If I can automate that and then get straight to the advice bit, how am I any worse off?
Might be a question of magnitude rather than nature, and probably. But I agree with you. I mean, it's not fundamentally. It doesn't seem to be fundamentally so different, but it could take proportions that it doesn't have today. And
now you control the information that you give. In an open kind of finance scenario, then the advisor actually have much more access to information.
Can I turn to the audience and participants in this room in particular? I mean, we have a fantastic panel here today. So please, why don't you take an opportunity? Yeah, Olivier. And Petra, then sure.
Thank you. Well, this is maybe a first idea or suggestions, but I think when we think about the Consumer Credit Directive that is currently discussed, I think the EDPB has published an opinion that shows and that demand for this proposal, this Consumer Credit Directive proposal coming from the Commission, to be more precise as regard the data to be made available for creditworthiness assessment and for marketing purpose, and that it should be clearly identify what are the kind of data parameters that are the necessary one and the minimized one to achieve a proper creditworthiness assessment, and for more or less the demand is the same as regard marketing purpose. And I wonder if it's not one of the maybe a path for a solution is to respect this GDPR spirit which is about data minimization, and to focus on the necessary one for the contract. Can't we imagine that it's provided to the consumer to say, I'm agree with the necessary, a minimized one, and it's an option. I can just click, it's on my profile, on my digital profile, or I'm okay to provide more data, maybe for marketing purpose, or I'm okay to go deeper and providing more personal data, whatever, for getting more discounting things or whatever. But I think we should opt for this kind of, let's say, option. It could be easier, ease life of consumers, and also respect a bit more and design a bit more concretely these minimization, let's say, of the GDPR, which is, in my view, still a bit challenged for the time being.
Mm-hmm. So thanks to that. Any reactions to this suggestion of an opting-in approach? I see people, nodding, so I think, okay, you got it. We'll tell Commission. Petra, you wanted to also ask a question.
If I can. So thank you very much for a very interesting discussion. I have a question on something that I am myself puzzling on. I don't have the answer. I do not expect us to reach the answer today. But since you are so into the topic, I would just happy to hear your thoughts on this. And I think, Hattel, you alluded to it. You said that if it maybe in the past was difficult to get a credit, and you probably already were sent away by other banks, now by giving more access to your data and showing your financial capabilities, the ratio of those who get the credit in the end is going up. So that's a positive. And I hear the same on the insurance side sometimes, that people who had, for example, on health, they had a past with health issues, that if there is more data available on where they are now, that they could actually be better insured than they are now if they get more data. Now, the hesitation with that argumentation from Supervisory, but I also think others, is, that sounds all very nice, but in the end, you could also have a result, or at least part of that solution might help some, but there might also be this group that with more insight in the data really gets excluded because they don't make the thresholds. And again, if you're once not accepted in one entity, then you probably won't be. So in a way, I think that is a logic outcome of more data, that you also find more information about the group that you probably don't want to give a credit to, maybe for good reasons. But how going forward are we going to deal with this question? And I haven't solved it yet myself. Don't expect perfect solutions from you. But if you have any ideas on that, that would be interesting.
Petra, just to, I guess, to clarify, in the case of credit, I think the exam question is easier because the bank and the supervisor are on the same side. We want to lend to customers where it's a good credit, the money will be returned, and we won't see the customer enter financial distress. We want to do business, and you want us to lend to customers only where it's responsible to do so. So in the event that the additional data leads to us understanding this customer, for some reason, is not a good loan to make, I think we'd be on the same side, and you'd say, actually, that's a good thing to know, and we're avoiding future distress. I think in the case of insurance, that is a more complex question, because you may start to see uninsurable individuals, and that's a form of exclusion that's quite high impact. That is not my domain, so I will carefully dodge that one.
Rim, you also wanted to take on this one, and Magda afterwards.
Thank you, very, very nice question. In fact, transparency always leads to what I call some will win and some others will lose. Now, of course, the ones who will win most probably will pay lower premium or lower interest rates, and the others eventually higher. Now, who is going to generally pay the higher are the ones who are needing most of those services, most probably. So how to deal with it? Maybe explicit subsidies or guarantees. So this is something to protect, in a way, those vulnerable populations. But this is, of course, we need to think about it.
And that requires probably defining groups of populations or certain types that should be treated differently, right? I mean, ex ante also. Magda. And then we'll have to conclude, I think, and I need to hand over to Petra.
Well, I think that's a very important question, of course. Looking mainly at the world of micro and small enterprises, that is not just individual and hence not insurance and health data, which is a very delicate issue, of course. I think the overall evidence at the moment is that it has managed to bring more inclusion, the sharing of data, digitalization. I've worked a lot with the G20 group. I chair a group which is called Global Partnership for Financial Inclusion. And there we work a lot with emerging countries, and the evidence is that actually digitalization has produced a lot of inclusion. So the balance is more towards greater access to finance for micro and small enterprises who didn't have access before. Of course, there is a major issue of this potential discrimination. There is a lot on this. I think in this case more from developing countries. In our country, we are working on this as regulator, as supervisor, because we are really afraid of the use of unexplained algorithms which have implicit discrimination. We know, for example, gender is a major issue because algorithms are developed mainly by males, but there is a lot of attention on this, and there might be other sources of implicit discrimination that we don't control fully. But so there is a positive side. We have to be extremely careful, of course.
Okay, thank you so much. Are there any quick questions that we should take? Yes, here. I see one hand. Please, why don't you shout simply?
Okay, thank you. Thank you. Gilles Saint-Romain from Groupe PPCE. No, I think one question you discussed about the consumer consent. It's one of the crucial things. We think we cannot do anything with data without be sure that the consumer agrees with that. But considering the fact that the consumer consent is difficult to obtain, is also the consumer. We have the consumer fatigue. We could bother the consumer. It's not fit to any use case for anti-money laundering. For example, you don't ask the consent. Shouldn't we think about all the legal bases of the GDPR for to be sure that we are in line with the customer wish? I mean, the execution of the contract could be also a way to do so. Maybe to Augustine on the consumer side.
Very simply, that will not be enough under the GDPR, certainly. The legal basis that you have in the GDPR are not kind of a la carte that you can say, okay, I use this one or I use that one. So unfortunately, under the current legal framework, if you're collecting and processing personal data, you will have to rely most likely on consent. There are explanations, we don't need to go out on when you can use it for contract performance or legitimate interest, and the EDPB actually has developed guidance on that. But I don't think we're going to escape the consent paradigm anytime soon, unfortunately. Thank you.
So thank you so much for all your insights, and I think we've been a long way into clarifying, hopefully, some of the challenges and also the great opportunities that could come from open finance. I think we've heard a number of suggestions also to establish the right balance between the consumers, the economic agents, the individuals at the end of the day, and corporations, which is good. I'm not willing to conclude on that because Commission is supposed to come up with something. So, but we'll certainly pass them this information and those exchanges. But we've heard a lot about still financial education, of course, which is part of the, which is one of the keys necessary. But also, I think we've heard a lot about some safeguards that can be envisaged, also to make it safer even in the short term. And I think that's also pretty reassuring. And again, we'll try to build on the experience gained with the PSD2 first times to when moving on with those new in the direction of those new frontiers. So thank you so much for your participation, Rim, Magda, Hetal, and you, Augustine. And I now hand it over to Petra for the conclusion of the day.
I'll say something first. Yeah. No, don't worry. Don't worry. And then
I was told it was written. Give it to me.
But yes, thank you for a very interesting, rich discussion there. And before we hand over to Verena, just a couple of points. So everyone who registered with their email address will receive a feedback survey soon. So do fill it in. It won't take long, but we will be interested in having that information, that feedback. Also, we'll be sharing Caroline's finished visualization on our website and also by email, so look out for that. And for those who need to refuel before their onward journeys, there'll be coffee and tea outside. But now I can hand over to Verena for the closing remarks.
Thank you very much, Claire, and I'm not Petra. No, it's a great pleasure to be able to close this successful day. First of all, welcome to everyone, and I want to particularly thank all the speakers on behalf of the three ESAs. You have really contributed enormously to an interesting discussion today, and so thank you very much for being here with us. All the speakers on the panels, but obviously also our two key speakers who we had on video, the Commissioner McGuinness and the MEP Paul Tang. So I would also like to thank Claire, all the ESA staff, and in particular the EIOPA staff, who've done a fantastic job of organizing this day for the first time in 3 years with some physical audience in the room. And I think it really makes a difference to having this type of event in being able to also mix and mingle in the coffee breaks and lunches and having a discussion. So really good to be able to do that. And congratulations to the whole team who's worked on this. Finally, I also want to thank all of you who have participated today, those here in the room, but also those who are online. I think it has been good that we were able to also make it reasonably interactive. That's always a challenge in these settings, but I think it's been good to see also the engagement through the various Slido questions and everything else. So we look forward clearly to continuing this engagement. The Consumer Protection Day is a really important milestone for us as the ESAs, because it really gets to the core of our work on consumer protection, and that is core to all three of us. It's really important, and also the work that we do through the Joint Committee. But this is not a unique opportunity. We obviously engage with many of you, but nonetheless, it's probably the one where we really are able to dig into some of the really important issues when it comes to consumer protection, and having so many consumer representatives, supervisors, members of the industry to discuss the current trends and developments and what the opportunities and challenges are for consumers is great. The day was filled with a lot of interesting contributions and also some nice episodes and little histories, so thank you for all of that. And let me very briefly, and I know you are all ready to get either a cup of coffee or go home, so I will be very brief, just reflect what we heard today. So first of all, we started with the keynote speech by Commissioner Mairead McGuinness, stressing the importance and relevance of the topics that we discussed today, and in particularly focusing on financial inclusion, but also sustainable finance and how to bring forward open finance. And I think there was a clear commitment to looking at all of those topics from the Commission. The first panel on sustainable finance was a really good discussion to think about the current framework on sustainable finance, where huge progress has been made, but I think also, and everyone realizes, still a lot to do to actually make it work and make it fit for purpose for the consumer at the end of the day. Because the issue is that ultimately, the consumer needs to have the right information to be able to make sustainable investment choices. And that is a challenge and will remain a challenge for all of us. The speech of Paul Tang, I think, was really inspiring and encouraging us to continue working on sustainable finance. He said that despite the various difficulties encountered, notably greenwashing and the issue of reliability of labels and ratings, it's clear that climate change does not stop, and that means that also our efforts should carry on and not stop. We should be really looking at that urgently. And so he advocated for us to pursue an ambitious agenda and gave us some interesting insights of how maybe to do that. Then we moved on to the second panel, where we discussed the access, excuse me, let's get my papers in order. Then we discussed access to finance. And again, that's an issue that is really of great importance for all of us. Access to finance for the consumer, and in particular to the vulnerable consumer, or as some I think have said, the underserviced consumer, is a key consumer protection concern that was also stressed throughout the day. As discussed by the panelists, the current unfavorable economic situation is very likely to worsen exponentially the situation of these underserved consumers. And it is likely that in the current situation, I think Petra said that at the beginning of the day, it will really make hard choices necessary in terms of how to make sure that consumers still think about the medium and long-term needs in finance, which won't be easy in the economic situation that we are getting into. And then the last panel that we just heard, I think on the fascinating topic of open finance, something I have to admit that is pretty new to us, at least in the securities market sector, but it's good to hear the experience you've had on the banking side. Leveraging on that experience of PSD2, I think it's really good to understand from the panelists the challenges, but also the opportunities that can come here, and making sure that we get great opportunities for consumers in the financial sector at large, but doing so in a well-protected and conscious of the challenges, particularly when it comes to data protection. So with that, I want to thank again every one of you individually here and online for being here today. I'm here to close the 2022 Joint ESAS Consumer Protection Day, and I look forward to seeing many of you next year. We don't quite know where it will be or exactly when, but we will let you know. And we hope to see you all there and continue the interesting discussions both at that event, but also throughout the rest of the year. Thank you very much.